Hi everyone, hope you all must be doing great. So I did a poll some 2 or 3 days back where I have requested you, I have asked you that on which topic I should make my next lecture. So most of the students have suggested that I should make lecture on the total income questions because we need practice, and this is something which is very important. I was expecting also that you will vote maximum vote you will give to that particular option. Although some students have also voted for capital gain, for TDS, and even I have received some personal requests where the students were asking that, sir, please discuss short and quick revision on deduction chapter also. So don't worry, I'll be posting those videos also very soon. But today, first of all, let us discuss with the total income questions. So I have came up with 5 important questions which has already came in ICI past year examinations. So these are very similar questions that you will going to see in your May 2024 examinations. I'm telling you this section, this particular session, although it would be a bit long, but I'm telling you that this session would be very fruitful. After doing this, after spending this time with me, you after this session, I'll assure you that you will feel very much confident. You will feel very happy that you are able to revise all these concepts which are related to your income tax, not only your 5 heads of income, but also clubbing, set off, deductions. We'll be discussing TDS. We'll be discussing everything today, right? How we'll be going to proceed with this session? First of all, I'll ask you to read the question. Then we'll discuss the question orally, one by one. We'll be discussing each and every point. And after that, I would like you to solve the question with me, right? You have to solve literally, you have to solve the question as per your examination. The same way as you will be solving your examination, the same manner we will be solving it today, right? So you have to give a commitment to me that you will be watching this entire, not only watching it, you will be working with me. You will be solving those questions with me. So let's start with this session, right? Okay, let's start with question number 1 now. First of all, I would request you to give a plain reading to this question. Just give a rough reading, a plain reading to this question for 2 or 3 minutes, and then we'll be discussing it. Okay, I'm changing the screen. Give it a plain reading. Pause the video here and just read it out. Pause the video. Okay, I'm changing the screen. Pause here and just read. And also read what the this question is asking from us, right? Done. Okay, so what the question is asking? Question is asking that we have to compute the total income and the income tax payable. Okay, two things the question is asking, that we have to compute the total income and the tax thereon. Okay, three different scenarios. First scenario is that we have to compute his business profit as if that person is opting 115 BAC, default tax regime. Okay, here we will compute his tax liability as per default tax regime, easy. B point says compute the business profit as per the provision of 44AD. 44AD is presumptive income. So here we have to compute his PGBP income as per presumptive basis, 4480, that's 6% or 8% of your turnover, as the case may be. And he does not opt for section 115 BAC. So here we have to compute his tax liability as per the optional tax regime because he is not opting 115 BAC. Okay. C point says compute the big business profit as per normal provision, not as per presumptive scheme. Normally, we have to compute his business income and he does not opt for 115 BAC. Here also we have to compute his tax liability as per the optional scheme. So first is default scheme. These two are optional scheme, but in B we will follow presumptive. In C we will do normally, right? So which option is advantageous to Mr. Pramod? We have to also comment. That is very important because some students, what they does in examination, they just solve these ABC portion, they don't comment. This is also very important because the question is asking from us that which option would be the best for the assessee. Okay, seems to be a good question because we have to compute everything. So let me discuss this question first with you. It says Mr. Pramod is a resident, age 55 years. Okay, he's not a senior citizen, is a retail trader and furnishes the following information for assessment year 24-25. Trading and profit and loss account is given to us. Opening stock, right? Purchases, transport charges, gross profit. And then we have other expenses like salaries, okay, rates and taxes, admin expenses, depreciation, net profit. Generally, all these expenses are seems to be fine to me, right? As of now. Yes, if there would be any information, any adjustment that needs to be done, we will do it accordingly, right? Otherwise, all these expenses are fine to looking like that they are okay with us. Yes, but this depreciation, we understand that we have to see if nothing is mentioned in the question. Then we will always assume that depreciation is as per section 32 only. If nothing is mentioned in the question, right? But if something is mentioned about depreciation, if in this information, if anything is mentioned about depreciation, then we have to proceed accordingly. Then we will say that this depreciation is as per books of accounts. Then we will not consider this. We will consider depreciation as per the information. But if there is no such information about depreciation, then please assume that depreciation is as per section 32. Got it? Okay. What's given in the credit side? So in credit side, we have sales, closing stock. Okay. Gross profit has been carried from trading account. Rent of house property. See, this is rent of house property. This should not be PGBP income, right? Because he is a retail trader and this should not be the PGBP income. This should be house property income. So we have house property head also in this question. Rent of furniture. See, his business, he's just a retail trader. He's not into the business of giving furniture on rent. So rent of furniture, if nothing is mentioned, then we will always assume that this is IFOS income. So we have PGBP also, house property also, and IFOS also in this question. Okay, what else? Let me read this information also. First information says all sales are through account pay check and through bank transfer. Tell me why this first point is given to us, that all sales, the entire sale, this sale 70 lakh 80,000, which is there in our PNL account. So it is through account pay check or through bank transfer. That is, it is through banking mode. Why? So why this point is given to us? Because somewhere they have asked us to compute the income as per the presumptive scheme, right? 44 AD. So we understand in section 44 AD, how do we compute the income of the assessee? We take 8% of turnover or 6% of turnover. When we take 6% of the turnover, when the entire, when your whatever turnover has been realized through banking channel, then we take 6% of the turnover. Correct. So here they have already mentioned that the entire sale is through banking mode. So we don't have to apply 8%. We will simply apply 6% over here. Right. So that is the reason they have mentioned this first point over here. Second point says opening and closing stock are overvalued by 15,000 and 20,000 respectively. So 15,000 is opening and 20,000 is closing, and they are overvalued by this amount. Okay. So let us understand first how we will proceed with this particular adjustment, because this adjustment is quite common in the questions. So let's say, let me discuss the opening stock first. See, if the opening stock is overvalued, if the opening stock is overvalued, it means that we have shown extra expenses, right? This is overvalued. So our opening stock is overvalued. That means that the assessee has shown some excess expenses. So what we will do is we'll rectify this. We'll make it correct. So what we will do is we will decrease it, right? Because it is overvalued. We'll correct it. We'll rectify it. To rectify it, we have to decrease, correct? If the expenses will be decreased, then what will happen to the profit? The profit will increase. Simple. So if the expenses are getting down, so our profit will be up in that case. So we have to add how much amount? 15,000 rupees to the opening stock. To our profit, we have to add this particular 15,000 rupees in our adjustment. Similarly, 20,000 closing stock is overvalued. See, our closing stock is overvalued by 20,000. That is, we have shown extra credit in our P&L account, extra income we have shown. So if we'll rectify it, what we will do is we'll decrease our closing stock. So if our closing stock will be decreased, our income side is getting decreased. That is, our profit will also be decreased, right? So what we will do? So to adjust this profit, we have to less this. We have to subtract 20,000 rupees. So 15,000 you will add, 20,000 you will subtract. I believe that this point is clear to everyone. Okay. Okay. Third point says rates and taxes includes GST liability of 5,000 paid on 1st May 2024. So on 1st May 2024, we have paid the GST liability and municipal taxes. Okay, this is something different. So this point, third point, contains actual 2 points. One is related to GST liability, second is related to municipal taxes. So first of all, let's discuss about GST liability. Tell me if there is any expense related to GST, customs duty, or any other taxes. Is it allowed? The answer is yes, sir. These GST, custom duty, or such type of taxes are allowed as per section 37. But yes, they should be paid up to the due date of ROI. But if this particular expense is related to income tax, if it is tax related to income, it is income tax, then we understand that income tax we don't allow, right? Income tax or provision for income tax, we don't allow that income tax. But GST liability, custom duty liability, that is something which we can allow, provided section 43B, remember that section 43B will also come into picture regarding taxes, because section 43B has certain expenses which are allowed only if they are paid up to the due date of ROI. So let's say Mr. Pramod, due date of ROI is 31st July 2024, or if it is 31st of October 2024. So here the actually his sales is not more than 1 crore. So his due date would be 31st July. So whether this amount is paid before 30 on or before 31st July, the answer is yes. So this GST liability of 5,000, we understand that GST liability is actually allowed if it is paid up to the due date of ROI. So yes, it is paid on 1st May 2024, before 2 or 3 months before, at least before 2 months before the due date, it is already paid. So we don't have to do any computation for this 5,000 rupees. Simply, we'll show a note that this GST liability is paid on or before the due date of ROI. Therefore, it is allowed. So we will not take this 5,000 into our calculation. We will not take 5,000 into our calculation. But yes, simply we will show this as a note. Okay. Second point says, so these rates and taxes include 5,000 GST liability. It is allowed. So we don't have to do any computation for that. Simply we will show it as a note. Second point, it says that in municipal taxes for the let out property is 7,000 rupees. Okay. This rates and taxes also include 7,000 rupees. What it is? Municipal taxes. See, municipal taxes of building are allowed if that building is used for business purpose. Then it is allowed. But here they are saying that these municipal taxes are related to let out property. So it is a let out property. It is this property for which we are getting a rent of 1,80,000. This is this property. And this particular 7,000 rupees relates to this property. So boss, this is your house property expense. This is not your PGBP expense. So we will disallow this 7,000 rupees. So do you understand the treatment of this point number 3? GST liability, we will not do anything, but yes, we will show it as a note, because it is also important to tell the examiner, because examiner has specifically given this particular point in our question. So we have to tell the examiner, boss, we know about this. That is the reason we are ignoring this 5,000 rupees, because it is paid up to the due date of ROI. But the 7,000 rupees is not our PGBP expense. This is the expense which is allowed in house property. So we will not allow in PGBP. We will add it back while computing our PGBP income. But yes, in house property, when we will be computing GAV, then after that, we will giving this 7,000 rupees as a, we'll subtract that from GAV so that we can get the NAV, correct? Fourth point, administrative expenses. There were administrative expenses. Yes, there were some admin expenses. How much? Admin expenses include 25,000 rupees paid to donation to National Children Fund and a payment of laptop purchase. First of all, let's discuss about National Children Fund. So this amount, admin expenses of 3.25 thousand, it includes 25,000 rupees. That is a contribution. That is a donation to National Children Fund. It is not a business expense. First of all, it is not a business expense. What we will do it, we will add it back, correct? We will add it to the our profit. And 25,000 rupees is eligible for deduction under section 80G. 80G, 100%. You understand this national word is over there. So we understand that 100% contribution to National Children Fund is allowed under section 80G if the assessee is following optional tax regime. See, if the assessee is following Default tax regime, we understand that chapter 6A deductions are generally not there. Only those three deductions, CC D2, CCH2, double J, double A is only there, right? Otherwise, if the assessee is following optional tax regime, then we can allow. So in point number B and C, we can allow it because here we are following optional tax regime. But in point number A, while computing the tax liability of point number A, we cannot allow 80G deduction. Correct? Okay. And what else? Admin expenses include this point. Okay. And admin expenses also include a payment of laptop purchased on 15/5/2023 for 60,000 through bank transfer. Okay. We have purchased the laptop also through a banking mode. But what we have done is we have debited this amount 60,000 rupees in this admin expenses. Tell me, is it a revenue expenses? The answer is no. We have purchased a laptop. So if we have purchased a laptop, it should not be debited. In fact, we should charge depreciation on it. And you understand on computers, laptops, printers, scanners, UPS, we charge 40% depreciation rate. So please add back the 60,000. 60,000 is the capital expenditure. You cannot deduct this in your P&L account, add it back. And then we have to take care of depreciation also. When we'll be computing depreciation, we have to take care about this point also. Correct? And how much depreciation will be charged? Charging 40%. Half or full? Sir, it's used from, it's purchased from this date. Put to use date is not mentioned. So we understand if put to use date is not mentioned, then purchase date will be the put to use date. So 15th May 2023, it is 180 days or more. So we'll be giving full depreciation of 40% on 60,000 also. I believe that this point is clear to everyone. Okay. Fifth point, transport charges. There were transport charges. Yes, there were some transport charges. Transport charges include 30,000 paid in cash on 1/9/2023. You have paid more than 10,000 rupees, right? If it is not mentioned, it means that in a single day that we have paid, right? And it is mentioned that on 1/9/2023 on a single day, you have paid this in cash. So it should be added back, right? Because there is also a section. If you remember the section number, you can quote that section number also. Otherwise, if you don't remember, it's okay. But yes, section 48.3 is there. This is a bit important section. So I would request you if you can learn this section number 48.3, right? There are some sections in PGVP which are quite important. So 43B is quite important. 44AA maintenance of accounts, 44AB tax audit. These are some important sections. You should know their section numbers, right? Okay, so 30,000 is paid in cash. So should we disallow it? Yes, we should disallow it because it is more than 10,000 rupees. But we also know that for transporters, we can pay up to 35,000 rupees in a single day. So here we are paying transport charges. So it will be assumed that it will be paid to a goods transporter, right? So this is allowed because this is up to 35,000 rupees. It is not more than 35,000 rupees. So here we will not be doing anything of 30,000. We will be simply showing it as a note, but we will not take this 30,000 rupees into our calculation. We will not add anything. We will not subtract anything also. Got it? Okay, easy. 6 point says, he incurred a loss of 8,000 on sale of equity shares on 10th February 24, which were purchased on 10/6/2023. So what this is, 8,000 rupees is a sale on equity shares loss. So this is, it was sold on 10/2/2024. It was purchased on 10/6/2023. So they were purchased in June 23 and we are selling it in February 24. Not more than 1 year, right? So it would be your short-term capital loss. It would be a short-term capital loss. And you understand that short-term capital loss can be set off only from short-term capital gain or long-term capital gain. And if these capital gain is not there, then we have to carry it forward. So we'll see if there is any capital gain, if we can set it off. Otherwise, we have to carry it forward because we have seen that house property is there, IFO is there, PGVP of course is there, but this loss cannot be set off from these three heads, right? So if there is any capital gain, then we can set it off. Otherwise, we'll carry it forward. Okay. 7 says, depreciation includes 1,200 rupees as depreciation on trademark wrongly charged at 15%. Okay, important point. See, this depreciation is 80,000 over there. It's this 7th point says the depreciation includes 1,200 as depreciation. This depreciation includes 1,200 as depreciation. What this depreciation is for? This is on trademark. This is on trademark wrongly charged at 15%. So So this is 1200 is actually 15% depreciation on trademark. But we understand that trademark is an intangible asset. So an intangible asset, we will give 25% depreciation, not 15%, right? So we have to give some more depreciation to it. How much more? 10% more, because 15% they have already given. So we will give 10% more depreciation. Then in that case, so you can simple do mathematics. This 1200 is equal to 15%. So we have to consider 10% more. So simply what you can do is 1200 divided by 15 into 10. This is the extra depreciation. How much it would be? 1200 divided by 15 into 10. Why 10 you understood? Because we have to give depreciation total 25. 15 has already been given, so we'll give extra 10% also. So this is coming to 800 rupees. So we will charge 800 rupees more depreciation. So if we'll charge, then what we'll do, add or subtract? We'll subtract, because we are increasing the depreciation. If we are increasing the depreciation, then also our profit will be decreased. So that is the reason we have to subtract it, right? And also, so here what we will do, see, in case of depreciation, only this point is mentioned. Here it is nothing about depreciation. This point is mentioned, and about 60,000 rupees the laptop which was purchased. So what we will see, we will take it like this, that this depreciation is good enough. This 80,000 rupees is as per section 32. Only that trademark adjustment that we have to do, that we will consider. So we will give that 800 rupees extra depreciation, and also depreciation on laptop. 40% on 60,000. So 60,000, 40%, it would be 24,000 this, and 800 rupees this. 24,800 rupees is the extra depreciation that we can claim. So we're going to subtract this. Got it? Eighth point. Eighth point says he deposited 50,000 in PPF account and has paid life insurance premium of 60,000 rupees. So we understand PPF is covered under 80C. Life insurance is also covered under 80C. So 50 and 60 is 1,10,000. Okay, maximum 1,50,000 we can give under 80C. So 1,10,000 is allowed, and nothing is mentioned about LIC sum assured. So if something is mentioned about the sum assured, then we have to take 10% of sum assured, 15%, 20% of the sum assured, as the case may be. So here nothing is mentioned about the sum assured. So we will see, we will take it as that 60,000 is an allowable investment. So 60,000 and 50,000, 1,10,000 we can claim under section 80C. But please remember, when you will be computing your income as per point number A, default tax regime, you cannot take 80C, right? Correct? While you will be computing your income and tax as per point number B and point number C, then you can take 80C, because here we are claiming computing our total income and tax liability as per optional tax regime. Okay, easy. He paid interest of 70,000 rupees on loan availed in financial year 18-19 for higher education of his wife. Okay, section 80E, education loan. So if the assessee is paying any interest on education loan, that is allowed under section 80E, correct? But there is also a point over there that once you start paying your EMI for educational loan, it can be allowed only for 8 years. For consecutive 8 years, it can be allowed for that 8 years. It cannot be allowed further. Correct? Do you remember that point? Please revise that point also. So under section 80E, if the assessee is paying interest on education loan, then it is allowed, but maximum for 8 years. Once he start paying this particular installment, from that year, we will count total 8 years, right? So let's say here it is mentioned that the loan was taken in this year. So it is not mentioned that when, from which date we have started paying this installment. So we will assume that we have started paying this installment from this year itself. So just calculate 8 years, and our financial year is, our previous year is 23-24. So if you'll calculate, I don't think that 8 years has elapsed. 8 years has not yet expired. So yes, now you can 80E would be allowable while computing your income under point number B and C, not in point number A, because in point number A, 80 is not allowed, right? That is default tax regime. So 70,000 is allowed because that 8 years period is not yet expired, correct? So this is question number 1. So now I would request you to please, I'm also doing this question, but I would request you that you can pause the video here. Whatever you know about this question now, because now I have also discussed about this question. So here you should start doing this question yourself. Also, I am doing it, but I'll make it in a fast forward mode. You can also watch this particular fast forward mode also, how I'm solving this question, so that you will be able to get a good idea about solving these questions. Okay, let's start with question number one now. So now this you will see, this is point number A, where we are computing our income as per default tax regime. So the house property income is 121, 100. We have made a note also. PGBP is 808, 200. Please check your answer. And there was capital gain, but it was a loss over there. So it cannot be set off from other income. So in that case, we have to carry it forward, right? And IFRS income is 1,20,000. So the GTI as per default tax regime is 1049, 300. But there would be no chapter 6A deduction because we understand that ATC and all is not available in default tax regime. Only the three deductions which are available in chapter 6A under default tax regime is 80 CCD2, 80 CCH2, and 80 double J double A. Remember? And these three sections are not here in this question. So in this case, chapter 6A deduction would be nil. Total income would be 10,49,300. And now we have to calculate the tax. But please remember, guys, although here we always have to see that whether this total income contains any special income or not. If it contains any special income, like if it has any long-term capital gain which is taxable at 20%, or it is having any income which is of 111A short-term capital gain on equity shares. Remember, the tax rate is 15% over there. And if it has 112A long-term capital gain on equity shares, 10% tax in excess of 1 lakh. And if it has casual income, then we would have applied 30% tax. So before calculating tax, it is very important that you should know whether this total income contains any special income or not. So if yes, so first of all, calculate tax on that special income. And then on remaining portion, then you have to apply the slab rates also. And also remember that provision, if this person is a resident individual or HUF, in that case, if the remaining income is less than the basic exemption limit, then you have to do the movement also, correct? If that is the case, when the remaining income is less than the unexhausted basic exemption limit, remember? So here there was no such case. Here the entire income is normal income, remaining income. So we'll apply the tax rate as per default tax regime. On first 3 lakh nil, on next 3 lakh 5% and so on. So our tax comes to 67,395. We'll apply cess 70,091, and at the end we can round it off. If you remember the section number, you can write the section number also. Otherwise, it's okay. You can just write rounded off 70,090. So this was the text as per your option number A, where you are following default text regime. If you would like to pause the video here, you can pause it right now. Okay. Now the B part was, the question was asking that calculate total income and tax as per the option text regime, where the assessee is following presumptive income, section 4480, right? So here what will change? Here the PGBP will change, because here what we have to see the gross receipts, and we will apply that because 4480 says 8% or 6%. But here my entire gross receipts is by through banking mode. That is the reason I have applied 6% over here. So the PGBP income would be 70 lakh 80,000 into 6%. That would be 424,800. House property income will remain same. Capital gain will remain same. IFOS income would be 1,20,000 same. So here the GTI is 665,900. And as of now, we are following optional tax regime. So chapter 6A deduction will also be available. So in this case, 80C, 80E, 80G would be available. So our total income comes to 460,900. And again, there is no special income. So we will apply the normal slab rates of 2.5 lakh. So first 2.5 lakh nil, on next it is 5%. So the total tax here comes to 10,545. And you can see that this person is a resident individual, and here the total income is not exceeding 5 lakh rupees. So here rebate will also come into picture. Got it? So how much is the rebate available? The tax on this income, or rupees 12,500, whichever is lower. So the rebate would be 545, and the tax liability would be nil in this case. In fact, this is the best option, B1, because our tax liability is coming zero over here. If you would like to pause the video here. Okay. Should I zoom in? Okay. You can pause the video here first. Now I'm changing it. You can pause the video here also. This was our B part. Now the last part, C1. Okay. Here we have to calculate our tax liability as per optional tax regime, and we are not following any presumptive income section. Here we will be following normal provisions. So the house property income will remain same. PGBP in fact will remain same, which we have calculated it earlier, right? So the GTI would be 1049 300. There would be chapter 60 deductions also available. Why? Because it is an optional tax regime. The total income comes to 8,44,300, and you can calculate the tax on it. There is no special income, so apply our normal slab rates, and which says the tax liability comes to 84,614.40. We can round it off. So it is 84,610. But this is not the good option. So we have to, at the end, we have to mention our conclusion also. So we are advising it. It is advised to opt for option B, presumptive scheme. Why? Because the tax in that case is nil. Got it? So if you want, you can pause the video here. This is the last option. And I'm changing it now. You can pause the video here. Okay, and now the working notes of this question. One was related to house property. Pause the video here, guys. And next was PGBP. Okay. Finally, over here. This is our working note. Got it? Okay. Now the next question. Okay, so the next question is question number 2. Let me read it out. Okay, first you have to read it. First, you have to read it. You can pause the video here. Just give a plain reading. Okay, I'm changing the screen. Again, pause the video here. Done? Okay. Pause the video here. Sorry. It is okay here. So what the question is demanding from us? The question is saying that you are required to compute the total income under proper heads of income for Mr. Bhasin for assessment year 24-25 under the regular provision of Income Tax Act, assuming that he has not opted to pay tax under section 115 BAC. Also compute the total tax payable by him. So we have to compute the total income. We have to compute the tax payable by him as per the optional tax regime, because the assessee is not opting 115 BAC. So all these deductions of chapter 6A and all, we can give that because the assessee is opting for normal, that is optional tax regime, not default. Okay, so you have already given it a reading. Let me read out also for you, and I'll be discussing each and every point with you, and then we'll do the question. Okay, here the assessee is Mr. Bhasin, is a resident individual, okay, age 52 years, not a senior citizen. Provides management consultancy services to various corporate and non-corporate clients. It means that Mr. Bhasin is a professional. His income and expenditure account for the year ended 31st March is as under. Income and expenditure account is same as our P&L account. So let me read out first the whatever is mentioned in the expenditure side and then on the income side. Here, employer remuneration. On the face of it, it is we can see that it's a salary to the employees, so we can allow. Office and admin expenses, okay. Rates and taxes, simple expense. Interest expenses, okay. Office rent you can pay. Under section 30, it can say that if you are actually paying a rent of your building which is used in your business or profession, you can claim that expense under section 30. But if it is a notional rent, then we cannot allow it. Okay. Insurance premium. You understand what is notional rent? So if you're the owner of this particular property and if you are paying this rent, you are just claiming it as an opportunity cost, then we are not going to allow it. Insurance premium we can allow. On the face of it, we can see that it is allowed. If something is mentioned in the information, then we have to work accordingly. Professional fees, okay. Depreciation on computers, okay. Excess of income over expenditure, that is simple profit. Okay, this much is the profit we have. On the credit side, we have gross receipts from profession 60 lakh 60,000 rupees. So this is what, this is a revenue, this is sales, gross receipts. Okay. Last year was 75 lakh. Why they have given us the gross receipts of last year? To tell us that if this person, because this person is running his own profession, so for profession, if your turnover is, your gross receipts is more than 50 lakh of the last year, so you are eligible to deduct TDS. So Mr. Basin, if he's paying, making any payment to someone on which TDS provisions is applicable, so Mr. Basin is eligible. So here, if this person is eligible, so if there is any information which is mentioned over here, which will be mentioned over here, that if we have made a payment to someone and we have not deducted TDS, then we will be going to disallow that 100% or 30% as the case may be. So Mr. Basin is eligible to deduct TDS also. Okay. Okay, one more thing is mentioned over here. No TDS was deducted from any of the receipts. What it is? Okay, let me read out this. Gross receipts from the profession is 60 lakh 60,000. And here it is mentioned no TDS was deducted from any of the receipts. So this amount which we have received, on this amount there was no TDS deducted. So whosoever client has paid this amount to us, that client has not deducted TDS of this amount. So it's okay with us because this amount is at a gross level. It is not after TDS. It is before TDS amount. So we always take, so whenever we compute our income, we always take at a gross level, right? So on this amount, there was no TDS deducted. So we can simply say that this is a gross amount. So there is no adjustment that needs to be made over here, because if this would have been after TDS, let's say they would have said in this way that TDS of 10% has been deducted on this amount. So we have to we have to change it to the gross level, right? We have to gross it up in that case. So you understand how you will be grossing it up. So if, let's say, if they would have mentioned it, that 10% TDS or whatever rate is generally on professional service, it is 10%. So if 10% of the TDS has been deducted, so you have to take the gross amount. So how you will be grossing it up? You understand, if 10% is deducted, so what we have received is 90%. So you have to gross it up. Let's say 60. You don't have to do in this question, but I'm just giving you an example. 60 lakh 60,000 rupees. If 10% TDS has been deducted, so it means that this is equivalent to 90%. Divided by 90 into 100, then whatever is the amount, you have to gross it up. So that amount you should take in your sales, as per your sales, right? But here you don't have to do this calculation. Why? Because they have already mentioned that no TDS was deducted. So this is before TDS. So you can, it is already at a gross level. So you don't have to do any type of calculation. Correct? Okay. Next point says, interest on saving bank account. We understand this is IFOS income. Simple. How much? 25,000. So what we have to do it while calculating our PGBP, we have to subtract it while computing our PGBP, but we will take it as our IFOS income, 25,000 rupees. And also, assessee is following optional tax regime. And we understand if the assessee is earning income from saving bank account interest, so we have a deduction 80 TTA, right? Remember, we have a deduction for 80 TTA. For assessee who are not senior citizen, 80 TTA. Maximum deduction under 80 TTA is 10,000 rupees for saving bank account only. So here we will be giving a deduction of 80 TTA also. But if this person is not a senior citizen, but if this person would have been a senior citizen, then there is another section 80 TTB would have been allowed over here, and maximum deduction under section 80 TTB is 50,000 rupees. But here we have to apply 80 TTA. Got it? Okay. Next is winning from lottery. How much? 99,500. It is a casual income. So while computing our PGBP, we'll be subtracting this amount. We'll be subtracting this amount, and we will be taking this amount to our IFOS, right? Is it after TDS? It is net of TDS. Net is written over here. But let me read the full statement. Net of cost of lottery ticket of 500 rupees. Okay. Do you understand this point? Net of cost of lottery ticket of 500 rupees. So first of all, tell me whether it is after TDS or not. This amount is after TDS. It is net of TDS or not? Yes, sir. Net is written over here. No, net is written over here. It is saying that after deducting the cost of lottery ticket. So let's say this assessee, Mr. Bhasin, has purchased a lottery ticket of 500 rupees. He has purchased a lottery ticket of 500 rupees and he won this lottery. And how much he has received, he has deducted that amount of 500 rupees from that, and then he has shown this to his P&L account. So tell me how much money he would have received. He had received, I think, 1 lakh rupees, right? Because this is net of 500. Net of 500 means after subtracting 500, the cost of lottery ticket. So you have to, first of all, while computing your PGBP, first of all, please subtract this 99,500 because this is not PGBP income, correct? And then take this amount to IFOS. But how much amount you will take to IFOS? 1 lakh rupees. Why 1 lakh? Because we understand from casual income, we do not allow any type of expenses. From casual income, there is no expenses which is allowed. So in casual, you will take it 1 lakh rupees, correct? Should you, is it after TDS or not? See, TDS thing is not mentioned over here. TDS, although TDS would have been deducted over here, but they have not mentioned it whether it is after TDS or before TDS. So if nothing is mentioned, we will take it as a gross amount. We will take it as a before TDS amount. Yes, TDS would have been deducted. 30% TDS, if it is, you have received 1 lakh rupees. So there would be 30,000 deduction would have been there. Because you understand on casual income, 30% TDS is applicable. So, but this amount is not net of TDS. Why? Because nowhere it is mentioned over here, it is net amount. If it is written net amount, just net or net of TDS, one and the same thing. So that we can assume that this is after TDS. But here, net amount is not, net word or net of TDS word is not written over here. So we'll assume that this is a gross amount. So while computing, you have to do two calculations over here. While computing your PGBP, subtract 99,500 because this is not PGBP, and take this 1 lakh rupees to IFOS. 1 lakh. Why 1 lakh? Because 500 rupees expenses is not allowed from casual income. So in 1 lakh rupees, we will be taking it to your IFOS. And whenever you will be computing, at the time when you will be computing your tax liability, then 30,000 TDS you can also claim, because 30% TDS is always applicable on this amount. So this amount, although this amount is a gross amount, but yes, 194B TDS would have been deducted, right? We will assume that TDS would have been deducted, but this amount is the gross amount, correct? I'll be also solving this particular point. Rent received 2,40,000. What is this rent received? This is house property income. So while computing, so we have house property income also over here. We'll be computing. Is it the house property income is 240 or this is the rent received? This is the rent received. So we can take it as a GAV, right? We can take it as a GAV. If there is any municipal taxes, we can subtract municipal taxes. We will get NAV, then 24A, 24B, and then we'll be getting our house property income. So here we have house property income also. Here we have IFOS income also, saving account, casual income. And here we have our PGBP, of course. So let me see if there is any other red income also. What else is left? Salary is left. Capital gain is left. Let us see if there is any capital gain or salary income or not. Okay, let me read the first point. It says, employee remuneration. Yes, there was some employee remuneration, 15 lakh. Employee remuneration includes a sum of rupees 3 lakh. Okay, this amount includes a sum of rupees 3 lakh. Paid to his wife, Mrs. Beena. Okay, related person. He has paid this amount to his wife, Beena, who is working as a manager in his office. Okay. She does not have any technical or professional qualification or experience required for the job. Okay. Something very much similar to section 64, clubbing. When the spouse is getting any remuneration without any technical, professional qualification or experience. You understand? Do you remember that chapter, clubbing? The payment of salary was as per the market rate in comparison to similar work profile. Very nice. First of all, we understand that whenever you make a payment to your related party, whenever you make a payment to a related person, so first we have to see whether it is made as per the market value, as per the fair market value, or in excess of fair market value. So here they have mentioned, in this point they have already mentioned that the payment of salary is as per the market rate. So 3 lakh rupees is as per the fair market value. So tell me whether section 40A2, whether section 40A2, which is whenever you make a payment to a related person, it will be attracted or not. The answer is no. it will not be attracted. Why? Because the payment is made at a fair market value. It is not made in excess of fair market value. If this would have been made in excess of fair market value, so that excess we have to disallow, right? But here they have already mentioned that this payment is as per the market rate, so 48.2 will not apply over here. Okay, so we can allow this 3 lakh rupees, but it will be the income of, first of all, it will become income of Beena. Under which head? Under the head salary, because she is receiving salary, right? But she is receiving salary without any technical or professional qualification, without any experience or skill, from a concern where her spouse, Mr. Basin, has a substantial interest. This business, this profession is owned by Mr. Basin. In fact, he's the owner, he's the entire owner, 20% or more. In fact, he's 100% owner of this business. So if we understand that clubbing provision, so if individual has a substantial interest in any business and individual spouse earns any remuneration out of it, then whatever is the remuneration which is computed in the hands of spouse, it will be clubbed back to the individual's account. It will be added back to the individual's hand, right? First of all, in clubbing, what you will do in clubbing, first of all, compute the income. First of all, compute the income in the hands of transferee. Here it is Mrs. Beena, and then take this income in the hands of that transferer. So we will take this income in the hands of Mr. Basin. First, we'll compute in the hands of Mrs. Beena. Please remember, first we'll compute in the hands of Mrs. Beena, and then we will take this income in the hands of Mr. Basin. So first of all, tell me, in Beena's hand, which head it is? It is salary, right? She's receiving salary income. So how much is the salary income? 3 lakh rupees. No, she's receiving 3 lakh rupees from that concern. There would be, you understand, when you compute salary, you give gross deduction, that section 16 standard deduction also of 50,000 rupees. So 3 lakh is the gross salary for Mrs. Beena. We have to give at least 50,000 rupees standard deduction also under section 16. So her income from salary is 2.5 lakh. Got it? 2.5 lakh you will able to calculate. 3 lakh minus 50,000. So 2.5 lakh is the salary income for Mrs. Beena. But this salary will be clubbed in the hands of Mr. Basin. Under which head? Under the same head. Under the same head. So which income is this? This is salary. So Mr. Basin in Mr. Basin's ROI, in Mr. Basin's return of income, there will one more head, salary head. Although I understand this person is having his own profession, but there would be salary head also. So we understand there was house property, there was IFOS, of course there is PGBP, and now there is salary head also. Very, very interesting point. Correct? Okay, capital gain is left. Let's see if there is capital gain also. Second point says, Mr. Basin owns a big house. Okay, with two independent unit 1 with 50% floor area and has been let out for residential purpose at a monthly rent of 20,000 for the entire year. Okay, so he has a big house and this is unit 1. Unit 1 is 50% of the floor area and this is let out at rupees 20,000 per month. 20,000 per month. This 2,40,000 which is shown over here, this is the rent which he is received. Okay, so this is a let out. This is house property income. Okay, and it says unit 2 with balance 50%. Okay, unit 2 with balance 50%. This is 50. This is let out area. This is the balance. Is used by Mr. Basin as his residence cum office, and other particulars are as follows. Municipal value, fair rental value, standard rent is given over here. Okay, the second balance. See, the unit 1 is let out. 50% is let out. This remaining 50% is used for personal purpose also, for business purpose also. So how much for business and how much for personal, for self-occupied? So if nothing is mentioned, then we will assume that this remaining 50% is being used equally in equal ratio. That is 25%, right? So 1/2 is nothing but 50% is let out. 1/2, the remaining 1/2 is used half for business. It is not given as half. But if it is given, then we will take that ratio. If it is not given, then we have to assume something. So we will assume equally. So 1/4, 1/4, right? Understand? 1 upon 4, 1 upon 4 is nothing but 25% is used for self-occupied and for business purposes, right? So I can say that 75%, you got it. See, 50% is let out, house property income, 25% self-occupied. Again, self-occupied NAV would be zero, but it will come under house property. And 25% is used for PGBP. So I can say that for the entire house, 75% is related to house property and this 25% is related to business. So whatever, if there is any expenses which are incurred for this particular business, 75% will be apportioning it towards house property and 25% we will be apportioning it towards our business. Correct? But yes, well, when we'll be computing house property also, we, because now we have multiple units, so we have to, how we have to compute our house property, we'll split it off. 50% will show it in a one column, remaining 25% will show it in a another column. This 25% we cannot show. Why? Because this is related to PGBP. Got it? Very interesting point again. And here they have given the municipal value for the entire house, municipal value, fair rental value, standard rent, that will be used in our computing our expected rent, right? Okay. Rates and taxes include a sum of 10,000 paid as municipal taxes of the house. So there were some rates and taxes also. Okay, there were some rates and taxes also. And 10,000 is paid as municipal taxes of the house. See, so I can say that 75% is related to 10,000 is debited to P&L account. 75% is related to your house property. 25% is related to PGBP. So out of this 10,000, 7,500 we are not going to allow it. Why? Because it is related to house property. And remaining 25% that we can allow if because they are used for PGBP purpose. Okay, very good question. 4 points. It says interest expense represent interest on capital borrowed from a nationalized bank for construction of the house. The construction was completed in financial year 11-12. Construction was completed in 11-12. There would be no point of pre-construction period interest. Why? Because it's been more than 5 years that the construction has already been completed. So there is no concept of pre-construction period over here, right? Because 5 years, those 5 years has already expired. Our previous year is 23-24. It's been that 5 years has been expired long back. Okay. Yes, but if there is any current period interest, that we can allow under house property. Neither the loan nor the interest was paid till the due date of filing the return of income. Okay, we have not paid the loan nor the interest also. Okay. So they are saying that this interest expense, I'm reading it once again. 4 point says this interest expense, there was interest expense of 80,000 rupees. They are saying that this entire 80,000 rupees is related to capital borrowed for the house, and this is the interest. Okay. We understand that 75% of the interest is related to house property. So while computing your PGBP, please disallow 75%. Please disallow 75%. Why? Because 75% is related to house property, and you can claim that 75% in your house property. Correct. And 25%, how much would be 25%? 80,000, 25% would be 20,000 rupees. 20,000 rupees you can allow because that is related to PGBP. So out of this 80,000, 75%, 60,000 would be, 75% is 60,000. 60,000 would be disallowed. 20,000 can be allowed because this is related to PGBP. But in PGBP, we understand there is a section 43B. 43B says that if you are paying interest to any bank or financial institution or so, in that case, that interest should be paid. PGBP says that interest should be paid up to the due date of ROI. And here they have mentioned this, that interest is not paid till the due date of ROI, right? So the remaining 25%, we were thinking that it is of PGBP, although it belongs to PGBP, but we will not be allowing it. Why? Because it is not paid. 43B will disallow it, correct? And what we'll do, so 80,000, 60,000 would be disallowed. Why? Because it is not PGBP. 20,000 rupees would be disallowed. Why? Because it is not paid. 60,000 we will take it in our house property calculation. Sir, in house property can it be allowed? Yes. In house property, whether 43B is applicable? No, 43B is PGBP section. Why it will be why it will be playing a role? It will not play any role in house property, right? 43B is PGBP section. So 60,000 in PGB in house property. There's so much PGB or house property happening. Okay. In house property, we can allow interest even if it is not paid. We can allow interest even if it is not paid. So this 60,000 rupees, not in PGBP, but in house property we can allow. And in house property, we know that interest is allowed on due basis also. So 60,000 will be allowed in house property on due basis. But yes, 60,000. So let me do a analysis of this 80,000 rupees. See, 80,000. 50% is related to, let me do it somewhere else. Let me do it over here. See, this is 80,000. 50% is let out portion. 25% is self-occupied portion. 25% is PGBP, right? How much is the amount? 80,000, 50% is 40,000. This is 20,000 simple. This is 20,000. This is not paid. We understand that these interest is not paid, but these two belongs to house property. So this will be allowed under house property even if it is not paid. We understand in house property we allow interest on due basis. This will be allowed under house property. 40,000 can be allowed in let out portion. 20,000 can be allowed in self-occupied portion, because we understand in self-occupied we can allow maximum 2 lakh rupees, because this person is, if this person would have been following default tax regime, then we cannot allow in for self-occupied property, we cannot allow in default tax regime. But this person is following optional tax regime. That is the reason now we are allowing it. Even for self-occupied we can allow it, but for self-occupied we have a limit of 2 lakh. But here we just need 20,000, we can allow it. So 40,000 would be allowed for let out portion, 20,000 will be allowed for self-occupied portion. 20,000 relate, this 20,000 is related to PGBP, but it can allow, it could have been allowed if this would have been paid, but this is not paid. So this is not allowed because 43B will play a role over here. It will say it will not be allowed because it is not yet paid up to the due date of ROI. Got it? A very, very interesting point again. Okay. Fifth point says, based on the actual rent received on unit 1, Mr. Bhasin has debited 2.4 lakh as the notional rent for unit 2. Boss, notional rent is not allowed. So what this person has did is, based on the rent, he is assuming that 2.4 lakh is the rent for the let out portion. So let me debit this as an opportunity cost also of 2.4 lakh for the portion which I am using it for my business. No boss, you cannot debit any notional rent. This is just an opportunity cost. So this would not be allowed. You understand? Office rent is allowed under section 30 if it is an actual rent. But if it is a notional rent, then we are not going to allow it. Okay. Next point. 6 point says, the expense on insurance premium of 72,000 represent insurance premium 72,000 rupees. Okay. The expense on insurance premium 72,000 rupees represents lump sum health insurance premium paid by Mr. Bhasin for 3 years, effective from July 23 to June 26, for himself, his spouse, and 2 dependent children. The said insurance premium was paid through account paid check. First of all, tell me this 72,000 rupees which this person has debited. First of all, tell me whether it is this is insurance premium related to his employees, or it is for himself and his family. It is for the assessee and his family. First of all, it is a personal expense. Disallowed. The 70,000 would not be allowed because it is a personal expense, right? Okay. So while computing PGBP, disallowed. Second thing is that when we have deduction, because this is related to health insurance and this is also paid not by cash, by any other mode. So we understand if you have paid your health insurance for yourself, for this for spouse, or for children also. Even in 80D we have dependent or non-dependent children also, right? Sorry, in 80D we have only dependent children, sorry guys. In 80C life insurance, the children could be dependent or non-dependent, but in 80D they should be dependent children. Okay. So he has paid for himself, spouse, and for 2 dependent children. So this 72,000 we can claim under section 80D. And how much we can claim under section 80D? 25,000 rupees, right? But again, an important point over here. See, 72,000 rupees is a lump sum payment for 3 years. It is a lump sum payment for 3 years. So can you take for this particular year, can you take this entire 72,000, or you have to do a proportionate amount? You have to just do a calculation which is related to this particular previous year, right? So what you will do is, now this is an important point. Please listen to this carefully. Please listen to this carefully. Whenever assessees pays a lump sum amount for more than 1 year, so first we see that how many previous years are involved here. So first we see how many previous years are involved. So it is from July 23 to June 26. Okay, let me explain this to you. It is from June 2023 till, sorry, June 23 or July? It is July 23. First July 23 to 30th June 2026. First of all, whenever under section 80D, please remember, under section 80D, if the amount is paid for more than one previous year, so you have to see how many previous year are involved. Although it is mentioned that this is 3 years, don't see this 3 years. Don't take it as a 3 years. You have to see how many previous years are involved over here. So tell me, if it is July 23, so we have previous year 23, 24 is involved over here. Okay. Previous year 24, 25 is there. Previous year 25 and 26 is also there. Okay, this year is ending on 31st March 26, but this is going till June 26. So we have one more previous year which is involved here, previous year 26, 27. Are you getting this? So in section 80D, remember, whenever the assessee has paid any amount related to health insurance for more than 1 year, we have to see how many years, how many previous years are involved over here. So here the previous year are involved, although this is only for 36 months, it is just for 3 years, but we have to see how many previous years are involved. So here previous year 23, 24 is also getting involved, 24, 25, 25, 26, and 26 some of the months of 26, 27 also, right? So here we have to divide it accordingly. So here if 4 previous years are involved, so whatever the lump sum amount is, it should be proportioned, it should be apportioned in 4 equal installment, in 4 equal installments. So what you will do is, sir, we have paid 72,000 rupees, divide this by 4, divide this by 4 simply. So you don't have to see that, sir, in this year 9 months are involved, here 12 months are involved, here 12 months are involved, here 3 months are involved. Please don't see it like this. You have to just see how many previous years are involved. You have to divide this lump sum amount by the previous year, the number of previous year. So the number of years here is 4. So for this year, you will say 18,000 relates to this year, 18,000 equal, 18,000 relates to this year, 18,000 to this, and 18,000 to this. And we are doing for this previous year. So for us, the amount which is paid for health insurance, we will take it as 18,000 rupees, and maximum we understand 25,000 is allowed, so will be allowing under 80D 18,000. Assessee is following optional scheme, we can give 80D but 18,000 rupees, right? Maximum 25 can up to 25,000 we can give, but it is the actual amount which is paid is actually 72,000, which is lump sum, but proportionately it is 18,000 rupees. Got it? This was very important. So whenever the amount is paid for more than 1 year, you have to see how many previous years are involved, and simply divide it by the lump sum amount divided by the number of previous year involved. Very nice, very good point was mentioned in this question. Okay. 7 point says the expenses on professional fees paid includes 1 lakh rupees paid to Mr. Ronak, an Indian resident, on which no TDS was deducted. Do you understand that this person was having his total receipts more than 50 lakh of the last year? He was eligible to deduct TDS, and on 1 lakh rupees he has not deducted TDS. He has paid to Mr. Ronak, who is a resident, 30% of which it will be disallowed. If you remember the section is 40 small. If you even don't remember the section, please remember that point, that if you are making a payment on which TDS provisions was applicable and you are not deducting TDS, 30% would be disallowed if you are making it to a resident SSC. Simple. This was a simple point. 8th point, it says there was only one block containing computers. So there was only one block. I have read in question also, they have mentioned that there was a depreciation on computers 120. Okay. There was only one block containing computers which came into existence only on 2nd April 2023. Okay, it was not from the very beginning, it came into existence from 2nd April. New laptop 160, printers and scanner 40,000. We understand printer and scanner will also form part of this computers block. So 160 plus 40 is 2 lakh were purchased. He charged depreciation 60% in the entire cost, 2 lakh. So this person, the entire cost was 60 and 42 lakh. So this person has charged 60% depreciation. 2 lakh into 60% is 1,20,000. That is the reason this person is showing 120 in the income and expenditure account. See, 120 was there, right? 120 was there. This is 60%. First of all, tell me 60% is allowed? No. So you will not be allowing this. So please disallow this 120. And now you have to allow as per the Income Tax Act. So Income Tax Act says then on computers, you can allow 40% depreciation rate. So please disallow that 120 and allow 2 lakh into 40%. That is 80,000 would be allowed. And would it be full depreciation or half depreciation? We have purchased it on 2nd of April. So it would be full depreciation, more than 180 days. Okay. So disallow that depreciation and allow this 80,000. Last point says Mr. Basin has also taken a loan for 5 lakh from a nationalized bank for higher education for his son. During financial year 23-24, he repaid principal 75,000 along with interest of 40,000. See, principal payment is not allowed under 80E, but yes, this interest is allowed under 80. So we have a deduction of 80E also. 80E also we have a deduction of 40,000 rupees that is allowed. That would be because this person is following optional tax regime. So we have 80E also, we have 80 TTA also, right? Okay. So what I would suggest you, please, now you can pause the video here. I'll be also doing this question in a fast forward mode. So you can also watch that particular clip. And then, but first I would recommend you pause the video here, do as much as you can of this question, of question number 2, and then compare your answer with my answer, correct? So let's start with the answer of question number 2. So this is our question number 2. We have to calculate tax and income as per the optional scheme over here. Income under that salary. Why salary? Because this income is being clubbed. It was the income of his spouse, but that income would be clubbed because she is getting salary without any professional or technical qualification or skill. So the gross salary would be 3 lakh of Mrs. Basin, and we have to give standard deduction also. So this would be 2,50,000, but this income would be clubbed in the hands of Mr. Basin, right? So there would be salary income also. This was a good point. Again, we have to compute the house property income. I'll show you the note also. 1,04,500. PGBP income was this, and we have gross total income of 42,82,000. And here deduction under section 80D would be applicable. Why I have done 1 upon 4 of 72,000, because 72,000 was a lump sum amount, right? And there were 4 previous year involved in that. There were 4 previous year involved in that. That is a case. We have to divide it by the previous year involved. So we have divided it by 1 by 4. So it is 18,000. Maximum deduction which we can get over here is 25,000. But here we will get 18,000 rupees because it is not exceeding that amount, right? ATE deduction would be regarding your interest on education loan 40,000. And also please remember, as there is a saving bank account interest of 25,000 rupees, correct? And this assessee is not a senior citizen. If this assessee would have been senior citizen, then there would be a deduction of TTB. But here, this person is not a senior citizen, so we'll get the deduction of TTA, but maximum deduction under section TTA can not be more than 10,000 rupees. So our total income comes to this amount. Now again, we have to see whether this income contains any special income. So yes, there was at least one. There was one income of casual income of rupees 1 lakh. So we have to apply 30% tax rate on that 1,30,000 rupees, and on the remaining amount we will apply the slab rates. So finally, our total tax after cess comes to 11,19,768. And yes, there was a TDS on lottery of 30,000 rupees. So the remaining tax payable is 10,89,768. And we can round it off also, right? If you remember that section, you can write 288B also, otherwise it is fine. So this is 10,89,770 is our tax payable. If you would like to pause the video here, you can pause the video here. First, pause it. Now I'm changing it. You can pause the video here. Let me zoom in the text also. This one. Got it? And the working notes. This first working note is related to house property, because we understand that the entire house, out of the entire house, 50% was let out. So 50% was let out, and the remaining 50% was used for both personal purpose as well as for your professional purpose. So in that case only, so for that remaining amount, for that remaining 50%, we have assumed that it is used equally. So here I have given this statement also, that it is assumed that the remaining 50% which is used for both residence come office purpose, we are using it equally. That is 25% and 25%. Got it? So if it is let out property, so first we have to compute the GAV. GAV is expected rent or actual rent, whichever is higher. So expected rent we have to take for the half of the house, for 50% of the house. So we have to take municipal value, fair rental value, whichever is higher, limited to standard rent. So in the question, this figure is related to the entire house. So we have to do only 50% of that. So the expected rent was somewhere about 2 lakh. You don't have to show it everything because it will be time consuming in that case. But just you can show this way, the same way which I have mentioned over here. So you can show it that we have taken this into consideration, actual rent into consideration, whichever is higher. So 2,40,000 is the higher amount. So this is our GAV. And municipal taxes paid for the entire house was 10,000 rupees, right? And out of that 50% portion, we have to take only half, that is 50%, 5,000 for this one. And why not for this one self-occupied? Because we understand if it is a self-occupied property, we don't take GAV or municipal taxes. We only start the question with NAV, and the NAV of the self-occupied property is nil. Correct? Okay. Now 24A deduction, standard deduction 30% of NAV, and 24B is interest on loan. So we understand the total interest was 80,000. For the entire house, it is 80,000. 50% for this is 40,000, we can give this deduction of 24B, and 25% for this one, that is 80,000 into 25% would be 20,000. We can give the deduction for self-occupied property also. Because for self-occupied property, we can take, if it is for purchase or construction, we can go maximum up to 2 lakh. But if it is for repairs, then we can go maximum up to 30,000. Please remember that. And also please remember that this deduction is only available for self-occupied property if the assessee is following optional tax regime. So here the assessee was following optional tax regime. That is the reason we have given this deduction. Otherwise, if the assessee would have been following default tax regime, we would not have given this deduction also. I believe that this is clear to you. So our house property income comes to this minus this minus this 124,500, and this is a loss of 20,000. So if we will aggregate the total, it will come to 1,04,500. This is our house property income. Got it? You can pause the video here and you can note it down. This is our working note number 1. And working note number 2 regarding PGBP. This one is the PGBP. Working note number 2. So our net profit as per P&L account was given. Whatever is the depreciation as per books of accounts, we have added it because we will be giving the depreciation as per income tax act, right? And also these things were credited in the P&L account on the credit side, but these were not related to PGBP. They belongs to some other head. Saving bank account interest, IFOS, house rent, house property, lottery income, casual income, IFOS. So I have subtracted it, correct? Then salary to spouse is at fair market value. So we have not done any adjustment over here. But yes, this salary would be clubbed in the hands of Mr. Basin, that we already did. Rates and taxes of the house, 75% related to house property, so we have disallowed that. Interest expense was total 80,000, 75% related to house property, so we have disallowed that. And remaining 25% was related to PGBP. But even we have disallowed. Why? Because it is not paid. So it is covered under section 43B. So if you have taken a loan from bank or financial institution and you have not paid the interest up to the due date, so we are going to disallow that, correct? Notional rent is not allowed. This is a personal expense, 72,000, not allowed. The hair TDS was not deducted. That is the reason we have disallowed 30% of it, and we have written 40 small a also, right? If you don't remember this section 40 small a, it's okay. You can skip this, right? But please remember this 30% of this would be disallowed, right? And finally, we will give the depreciation on laptop, printers, etc. of 40%, which is the correct rate as per section 32. So our depreciation would be 80,000 in this case, and the PGBP income, if we calculate, comes to 38 lakh 2,500. Got it? So you can pause the video here and you can write this working note as well. Now come to next question. So our next question is question number 3. It says, I would like you to read it out first. So read this question first. Pause the video. First read it out yourself. Give a plain reading to it. Okay, I'm changing it, the screen. Pause the video here and just give a plain reading. Done? Okay. Now what the question is asking from us, here we are required to compute the total income and tax payable by the assessee for this assessment year as per the regular provision of Income Tax Act, assuming that he has not opted for 115 BAC. The person is not opting for 115 BAC. As per optional tax regime, we have to compute his total income and tax payable. Okay. Second point says, what will be his total income and tax payable if he opts for the provision of section 44 ADA? 44 ADA is presumptive scheme for a specified professional. Okay, where we take whatever is the gross receipts related to his business, we take 50% of that gross receipts as his business income. So here we have to, in point number B, in point number 2, it is asking that please compute their PGBP income as a 44 ADA and then compute their total income and tax liability. Will it be more beneficial for him to adopt 44 ADA or not? And then we have to comment that which particular option, first option or second option, which is the best alternative for this assessee. Okay, seems to be a good question. So here it is mentioned to us that Dr. Rohan, a medical professional, notified professional, that is the reason they were mentioning 44 ADA. Dr. Rohan, 82 years old resident surgeon, 82 years, super senior citizen, and this person is not opting for default tax regime. So now our age does matter, right? Because here this person is a super senior citizen, so we will be applying on the normal tax, on the normal income, we'll be applying the slab rates. That would be 0 to 5 lakh nil, 5 to 10 lakh 20%, 10 and above 30%, right? So this person is a super senior citizen. Okay, is a 82 years old resident surgeon having his nursing home in Mumbai. Give the following particulars for the year ended 31st March 2024. Okay. And if you will see that receipts and payment account is given to us. Income and expenditure account, P&L account is not given to us. Receipts and payment account. Receipts and payment account is a simple, you can say it's a kind of cash book or a bank book. Whatever we receive during the year, we just dump it in our debit side. Whatever payment we make, we just show it in our credit side. Whatever is the opening balance, this opening balance is the opening cash or bank balance. This closing balance is the closing cash or bank balance. We don't have to consider that into our computation, because this is simply opening and closing balance of cash and bank, right? So what we have to do it, because whenever these types of question will come in your examination, receipts and payment account is given to us. So your approach should be that you have to compute your PGBP income or other heads income, right? So let me talk about PGBP first. So you have to identify, first of all, for PGBP, because it is not a profit and loss account or an income and expenditure account. So direct net profit will not be provided to you. Here you have to compute the net profit, which is very easy. So while computing, let me discuss with PGBP. I'll be discuss for other heads also. For PGBP, you have to identify that the receipts which this person is showing, whether that receipts belongs to his business or profession or not. If it belongs to business and profession, just keep it as a receipts. And whatever the payment which this person is making related to PGBP, if there is any expense which is being made and which is allowed under section 30 to 37, then you can subtract from these receipts. So whatever is your receipts related to PGBP, you can debit the expenses, you can subtract those expenses, so that you can compute your business and profession income, here profession income, right? So our approach in receipts and payment account is that we have to compute our net profit as per PGBP. Okay. Now let me read this out first. First of all, this is the opening balance. This is opening cash and bank balance. We don't have to do anything for this opening balance and closing balance also. First of all, fees from visits to other hospital. Tell me whether this person is a medical professional, doctor. So he has received fees from he visits some other hospital also, and other hospital pays him fees. Whether it is a professional visit, the answer is yes. This is PGBP income. So while computing PGBP, we'll take it as a gross receipt. This is our gross receipts. Okay. See, here it is mentioned net amount. This is net amount. What does this word net means? Here net means that this is net after TDS. This is the amount after TDS, 5,85,000. But we know that whenever we will compute our income, we take it at a gross level before TDS. So what we have to do is we have to we have to gross this amount up. So how we'll do it? First of all, tell me if this amount has been given by other hospital because of professional services. There is a section in TDS. Even if you don't remember the section number, section name, still you remember the provision that on these professional services, TDS rate applicable is 10%. TDS rate applicable is 10%. So whatever the amount which we have received is equivalent to 90%. So you can simply gross it up. How you will gross it up? You will say, sir, this amount is equivalent to 90%. So 5,85,000 divided by 90 into 100 should be my gross amount. And that gross amount you should take as your PGBP income while computing your PGBP. Correct? And if you remember the section number also, it's fine with that. 194J is there, which says that if you pay any professional for any payment regarding professional services, you have to deduct 10% TDS. So this amount which we have received from other hospital, which this person, Dr. Rohan, has received from other hospital, so that hospital must have deducted 10% TDS, and here net amount is mentioned. So while computing your PGBP, while computing your gross receipts, please gross it up. Okay. Second is fees received for the month of March 23 received in April 23. Okay. This fees receipt 85,000 was related to March 23 last year and it is received in this year. So this income belongs to last year. So whether this income should be taxable this year or last year, it depends upon the assessee how he keeps his accounts, whether he keeps his accounts on mercantile system basis or he maintains the accounts on cash basis. So if this person maintains the accounts on mercantile system basis, then 85,000 should not belong to this year, it should be last year income. But if this person maintains the accounts as per the cash basis accounting, then this 85,000, although it belongs to last year, but it will be taxed in this year if this person maintains his accounts as per the cash basis accounting. Is it mentioned somewhere how this person maintains the accounts? Yes, it is mentioned. Point number 8. It says that he keeps his books of accounts on cash basis and has not adopted for the provision of section 44 ADA. Okay, this person is not adopting 44 ADA, although they have mentioned us that if this person would have adopted 44 ADA, what would have been income, that we will calculate. But we need this information. We need just this information that this person maintains his books of accounts on cash basis. So if cash basis is mentioned over here, then you will say that although it belongs to last year, but it will be taxed in this year, right? Sorry. Now you can ask me, sir, if this point would not have been mentioned in the question, then we always presume that assessee maintains their accounts on mercantile system basis. Then we can say that we can give it a note that we have presumed it. If you would like to presume that the assessee maintains on cash basis, then you can go ahead. It depends upon your assumption. Generally we presume that we maintains books of accounts on mercantile system basis. In that case, this income would not form part of this year, right? But here it is mentioned that it is particularly mentioned that he is maintaining the accounts on cash basis. So you will be taking this amount also into the income related to this year, right? Okay. They have given a bifurcation also. This 40,000 is related to IPD, 45,000 rupees is related to OPD. You don't have to take this into consideration because this is 85,000 rupees is the total amount which he has received. But these are quite medical jargons. IPD is inpatients, OPD is outpatients. So the patients who are admitted into the hospital, those patients who admit into the hospital, they are called inpatients. But in case whenever we suffer from fever or cold, so what we do is we visit any doctor's clinic. We that doctor used to write a prescription and then we take medicine from a chemist shop and then we come to our home we used to come to back to our home. So whether we get admitted into the hospital, the answer is no. So that is in case that is outpatient, we are not admitted into the hospital, it was simple fever or simple cough or cold, so that is OPD. In IPD is that, let's say if there is any person met with an accident or so in that case he has to get himself admitted into the hospital, that is called IPD. But these are medical jargons, you don't have to do anything related to text, but you should know about what is these are simple terms, IPD and OPDs. Okay. Dividend from shares. So tell me, when you will be computing your PGBP, will you be taking this amount also into consideration? The answer is no, because why not? This is not PGBP, this is IFOS income, right? So please don't consider this while computing your PGBP. Yes, but you have to take it in your IFOS. And how much you will be taking it into IFOS? 18,900 or the gross amount? See here, net is mentioned over here. We understand on dividend. How much is the TDS rate on dividend? 10%. So this amount is again equivalent to 90%. So just gross this amount up, 18,900 divided by 90 into 100. That will, you have to show this in your IFOS. And because this amount is getting, TDS is getting deducted. So whenever you will be computing your tax liability, so this TDS amount which has been deducted, please take a credit of that also and show the net amount which is tax payable or tax refundable as the case may be. That I'll be showing it to you. Okay, don't worry about it. Fees received during the year 10,25,000. This is the normal professional receipt. So this is professional receipt. This is professional receipt. This is professional receipts. Okay. Gift received from relatives of patients. Gift received from relatives of patient. Is it? It will be covered under IFOS. or it will be covered under PGBP. Is it a part of professional receipt? The answer is yes, because we understand in section 28 we have learned that if there is any gifts, if there is any benefits or perquisites which is received during the course of our business or in the course of our profession, that forms part of our business income. So this again, although these are gifts, but why we have received these gifts? These are received from the relatives of patient. It means it is during the course of our business or profession. So this will also form part of your gross receipts of the PGPP. So this amount, this amount, this amount, and this amount will be computed as your gross receipts. And whatever the expenses is allowed, you can debit those expenses so that you can compute your PGPP. Okay, what else? Honorarium for painting services in Jai Hind Art School net 22,500. What it is? It is a professional receipt? No, it is just an honorarium which he has received. Let's say this person is also has a hobby of painting, so he has visited any institution and that institution has paid him an honorarium. So that is an IFOS income. So this is not a professional PGBP income. This will go in IFOS. And again, this amount is net amount, that is after TDS. So this person has rendered professional services. So 10% TDS must have been deducted on this. So please, again, you have to gross it up. 22,500 divided by 90 into 100. Please make it IFOS income. Income tax refund. Income tax refund, we understand that is not our income. It is not treated. Income tax expense is not allowed. Income tax refund is not our income. But if there is any interest on income tax, you remember this? Interest on income tax is our IFOS income. So 12,100 is income tax refund, but includes interest of 1,500. See, 1,500 will go in IFOS. Correct? Okay. Let us read the payment side also. Salary to staff. Salary to staff is allowed. You understand this is a business expense. So whatever is your gross receipts, you can subtract salary to staff. If there is any adjustment, any information, then we will work accordingly. Otherwise, prima facie, it is allowed under section 37. If you don't remember the section number also, you know that salary to staff is allowed. Taxes and insurance. Okay, if nothing is mentioned, then we will say it is allowed as a business expense, professional expense. Entertainment allowance. Tell me whether entertainment expenses are allowed in PGBP. The answer is yes. Staff welfare expenses, advertisement expenses, business promotion expenses. These are similar expenses which any business or any profession used to incur to promote their business, to promote their profession. So these are allowable expenses. If something is mentioned, then we'll see it accordingly. But entertainment allowance or entertainment expense is a normal business expense or professional expense. It should be allowed. There is any adjustment, we will see. Purchase of television, is it allowed? First of all, if it is, tell me if this television is first of all, it is not a business expense. Let me clarify on this point. If it is I think something would be mentioned over here. If this is related a TV which is installed in his own home, it's a personal expense. It will become a personal expense, and on that expense, no depreciation will also be allowed. But if this TV is installed in his office or in his nursing home, then it will become a capital expenditure related to business. But in that case, you should apply depreciation rate. And on TV, simple plant and machinery, you can take it in plant and machinery block and you can apply 15% depreciation rate. Okay, we'll see it. Gift to daughter-in-law. This person has gifted some amount, 60,000 rupees to daughter-in-law. That is again a personal expense, not allowed. Interest on loan for repairs of property. See, if this property is related to PGBP, then if you are paying interest also, then it would be allowed. Otherwise, we will see if something is mentioned on it. Personal medical expenses. No, personal medical expenses are not allowed. Because why? Because these are personal in nature. But here, there is something which is hidden over here. Personal medical expenses. See, this person is a super senior citizen. This person is a super senior citizen. And this person has expended on personal medical expenses. And this person is also following optional tax regime. So chapter 6 deduction is available. We have a deduction under section 80D. Do you remember 80D? 80D is related to health insurance premium. But if the assessee is resident senior citizen, and if he is not getting any health insurance premium, he can even pay for medical expenses. He can also pay for medical expenses. So here this person is a super senior citizen and he's paying medical expenses. So it is a hidden adjustment over here. So you have to give, although it is not a business expense, it's a personal expense, but 80D is allowed. 80D is allowed. And how much maximum amount is allowed under 80D? Because this person is a senior citizen, in fact, super senior citizen. So up to 50,000 is allowed. So although he has paid 70,000, but when you will be giving a reduction of 80D, please give 50,000 rupees, right? Deposit in PPF, it's an investment, 80C will be allowed. Nursing home expenses, business expense. Professional fees paid for consulting services, business expense. Furniture, purchase of furniture at home, no, personal. This is not. Will you be allowing depreciation on that? On furniture and fitting, 10% depreciation is there. Will you be allowing 10% depreciation? No, why not? It is a personal furniture. Personal expenses, obviously, it will not be allowed. Balance carry forward, what you will do with of balance carry forward? Nothing, because this is simple, a closing cash or bank balance. Okay, let me read the information also. In information, it is mentioned that first we have already read, he keeps in books of accounts on cash basis. Okay, that point we have also already taken into consideration. And he has not opted for the provision of section 44 AD. That means we have to compute his normal income, not assuming as per 44 ADA. But yes, in point number 2, they are again asking that this, let us assume that if this person would have been following 44 ADA, then simple, whatever the gross receipts are. Tell me how much is the gross receipts? This amount, gross amount. Please take this at a gross amount, right? Because this is net. This amount is a gross receipts. This amount is a gross receipt, and this 45,000 also is the gifts from relatives, patients. This will also be considered as a gross receipt. So this amount, this amount, this amount, and this amount, you have to take 50% if you will be following 44 ADA in point number B, right? Okay. Second point says salary includes 60,000 paid to his sister, who is a qualified nurse. So you are paying it to a related person, but she is qualified. Okay. Paid in cash, this is a problem because you have paid more than 10,000 rupees in cash. So 60,000 will not be allowed. So how much would not be allowed? More than 10,000, 50,000 will not be allowed, or entire 60,000? Sir, entire 60,000 will not be allowed. Why? Because it is paid more than 10,000 you have paid in cash. So if you remember the section, you can mention 48.3. Otherwise, it is fine even if you don't mention the section number, but please apply the provision. Entertainment expense includes entertainment accounts that I was discussing, that is generally allowed, but now they are saying something about it. Entertainment expense include 25,000 for dinner to doctors in a 5-star hotel. Whether it is allowed or not. Is it a personal dinner, or this person has given a dinner to his family members, or he has given it to their colleagues, to doctors, to other doctors? So it is a kind of business promotion, it is a kind of professional promotion. So this is allowed even if it is given to doctors. If it is a 5-star hotel, that doesn't matter. So it is related as a business promotion expenses, no problem with this. You don't have to consider this 25,000, but please just show it over there, give it a note over there while computing your PGBP. Give it a note that this is an allowable amount, right? D point. Interest on loan for repair to property includes 40,000 for his residential property. So we have seen something, 65,000 is the interest on loan for repair. But they have said, they are now saying that out of this 65,000, 40,000 is related to personal nature. So please disallow 40,000. So while computing your PGBP, only allow 25,000, which is related to PGBP. Do not allow that 40,000 because that is personal in nature. E point says, his daughter-in-law earned 10,000 from the amount received as a gift. Very good point. Here, clubbing provision will apply because this person has gifted some amount to her to his daughter-in-law. This person has gifted some amount to his daughter-in-law, and if daughter-in-law, you remember that clubbing provisions, spouse and daughter-in-law. So if daughter-in-law is earning some amount on this particular gift, so that income would be clubbed again. So this income, 10,000 rupees, which the daughter-in-law is earning, that 10,000 rupees, but this would be IFOS income. 10,000 rupees will be clubbed in the hands of transferor Dr. Rohan. Fixed assets value as on 1/4/23 RS under. Okay, why they have given this point? For depreciation, because in this is simple receipts and payment account, right? Non-cash expenses will not be shown over here. So they have given us information regarding depreciation, that please take depreciation also into consideration. Nursing home equipment opening balance 2,20,000. Medical books including annual publication. You understand, for all books we have 40, including annual publication also we have 40% depreciation rate. Medical books is 35,000. Laptop is 40,000. Speed. First of all, tell me whether you will be making the entire format for computing depreciation? The answer is no. Please remember, see, the time is very limited in your examination. We have just 3 hours, right? And in that, we have to work very smartly. Please save your time. So tell me whether this is a total income question. This is not a depreciation question. Depreciation is just a single adjustment over here. This is not a depreciation question. This is a total income question. So please don't waste your time in making that entire note about depreciation, that this is the opening value, this is the addition during the year, this is the money received on sale or disposal. Please don't waste your time over there. Had it been a depreciation question, then if let's say if there is a separate question for 6 marks or 5 marks, which is only related to depreciation, then you can you can make that format. But here you are not required to make that format unless and until nothing is mentioned. If anything would have been mentioned that this amount was added during the year, this amount was subtracted during the year, then it makes sense that you can make that particular format. But here there is no requirement. Simply give a one liner and calculate your depreciation. So if the nursing home equipment, there was 2,20,000, simply calculate 15% depreciation rate. On equipments, you understand 15% is the rate. Medical books, 10,000. Total it was 35,000. It was 10,000 was included over here. 10,000 is not relevant because on 35,000 we can give 40% depreciation. Laptop 40,000. So what you can do is you can add both of them because on laptops also and on books also we have 40% depreciation rate. So on 75, 35 plus 40, 75,000, please apply 40% depreciation rate. Television purchase. Okay, there was a purchase of television also. Television purchase for nursing home purpose. That television is for PGBP purpose. So you can apply depreciation on that. It was purchased on 21/9/23 and is put to use on 3rd October 23. So you have to calculate the number of days. I think from 3rd October, if you will calculate, it is 180 days or more. So if it is 180 days or more, then on this television, you have to give depreciation at a rate of 15%. So how much was the depreciation? 48,000 was the cost of that television. Apply 15% rate. If it is 180 days or more, I think it is more than 180 days. 180 days or more, then apply full rate. He has donated 10,000 towards PM Cares Fund. Okay. So this is allowed under section 80G. This person is following optional tax regime. So 80G is allowed. And on PM Cares Fund, you understand 100% deduction is available. Okay. Now I would request you to again pause the video here, right? Do as much as you can and then compare your answer with my answer. Okay, let's start with this. So this is your answer number three. Let's come to the working note first, guys. Okay, so this is the working note. See, there was a very little information regarding house property. Still, there would be a house property income. In fact, rather, there is a loss because it was given to us that the assessee has paid interest for their personal house property. Nothing extra was mentioned, so we have assumed that it is a self-occupied house property, correct? So NAV would be nil, 24A deduction, standard deduction, 30% of NAV, of course, it would be nil. But yes, 24B deduction would be available, interest on loan. And here, how much interest on loan we are paying? 40,000 rupees is the interest on loan, but that is for repairs purpose. And we understand if the assessee is following optional tax regime, then only we can give 24B deduction in respect of self-occupied property, correct? Because if assessee would have been following default tax regime, so for self-occupied property, 24B is not available. 24B is available only for let out or deemed let out property in default tax regime. I believe that you remember this point, correct? Second point, because the assessee is following optional scheme over here, so we can give this deduction. But for repairs and renewal, maximum deduction available for self-occupied is 30,000 rupees. Got it? So here we'll get this particular deduction of 30,000 rupees, and house property loss would be negative 30,000. And yes, if the assessee is following optional tax regime, then house property loss can be set off from other heads of income also. But in default tax regime, you cannot set off house property loss. Got it? From other income. In that case, you have can only carry it forward if the assessee would have been following default tax regime. But here the our assessee is following only optional tax regime. That is the reason this loss can be set off from other heads also. Now the PGBP income. See, here you will be calculating the PGBP income because in this question, you have not been provided with PNL account, you have not been provided with income and expenditure account also. What the question has given to you, receipts and payment account. It is like a cash book. So whatever you have receipts, you have to check whether it is my professional receipt or any other receipt. So first of all, we have to calculate how much is the total receipts for this year, and we have to also calculate the payment which we have made related to your PGBP. So this is how we will be computing our PGBP income. So if you look in your receipt side of your receipts and payment account, you will find certain receipts, but out of those receipts, you have to choose only those receipts which are related to your PGBP, correct? So here, fees from other hospital, you have received 5,85,000 rupees from other hospital. And here it was written in the mention in the question that this is the net amount, net of TDS. So we understand. So if the assessee has rendered professional services to some other hospital, they might have deduct TDS under section 194J at rate of 10%. So the amount which we have received is just 90%. So we have to gross it up. So after grossing it up, it comes to 6,50,000, right? So 585,000 is the net amount, 6,50,000 is the gross amount that will become our income. Obviously, the TDS has been paid of 65,000 rupees. Got it? 65,000 rupees is the TDS. We'll get the credit of this TDS paid. Once we will be calculating our tax liability, then we can take the TDS credit also. That I'll explain you also, right? And second is this is the fees related to the month of March 2023. But why we are taxing it over in this year? Because the assessee is following the accounts on cash basis. So that is the reason we will take this particular 85,000 also as the income of this previous year. And this is the normal fees which the assessee has received, 10,25,000. That will also be form part of our income. And the last one, these are the gifts, perquisites which is received during the course of your business or profession. This again will be calculated, will be computed, will be treated as your section 28 income. So it will also form part of our gross receipts. So our gross receipts comes to rupees 18 lakh 5,000 rupees. I believe that this is fine with you. Correct, guys? Okay. Then we have to see the expenses which are allowed while computing this PGBP income, because this is the revenue amount. This is the gross receipts. Now we have to calculate it, the expenses also. Only those expenses we have to consider which are allowed as per PGBP. So when we'll see our payment side, we will found certain expenses, and there was salary 3,50,000. It could have been allowed, but we have given information that 60,000 of the salary was paid in cash. So that is the reason we are not allowing it. So if you remember that section also, 40A3, you can mention that section. Otherwise, it is fine. You can mention this one also. So out of 350, 60,000 is not allowed. So you can only subtract 2,90,000 as an expense. Taxes and insurance, no problem, you can subtract. Entertainment allowance, staff welfare allowance, business promotion allowance, advertisement allowance, these are all allowed, treated as your PGBP expense, it is allowed. Even if there is a expense or related to dinner to certain doctors in five-star hotel, that is all. That is perfectly fine. That as business or profession promotion expenses, right? So these are allowed as per PGBP. Interest on loan amounting to be 65,000. But it was mentioned that 40,000 related to your personal nature. So you can only allow related to your PGBP, that is 25,000 rupees. Nursing home expenses simple, professional fees paid simple. Depreciation. Here you have to compute the depreciation also. And please remember, guys, this is a total income question and it's a very time consuming question. In fact, the first question which comes to you, it's always time consuming. So you have to be very smart in that. So while calculating your depreciation, I would strongly suggest you that please don't make any type of format for each block. You do not have to make any type of format, right? Simply calculate the depreciation in the most efficient manner, in the most fast manner, I would say. So on equipments, it was 2,20,000. We can apply 15% rate. On books and laptops, total is 75,000. You can apply 40% rate. And on TV was also as a plant and machinery, and normal rate, general rate of 15% would be charged. And this is also used for more than 180 days. So we'll be calculating the full depreciation 15%, right? Please do not show that format, opening WDV additions during the years or money received on sale or disposal, because that would be very time consuming, right? This question was of total income, not of just of depreciation. Depreciation is just one point over here, right? It was one of the information, right? So you don't have to mention that, you don't have to show each and every block, right? That would be very, very time consuming. Yes, I do agree. If the question would have been just for depreciation, let's say there is a question of 6 marks and which is related to only depreciation, then you can show that format. In that particular case, that format is necessary. But here, this format was not at all necessary. You can easily show it in this manner, right? This is 100% fine. Examiner will give you full marks. Correct, guys? So 70,200 is the total of this depreciation. So 7,88,800 is the PGBP income. So this is our PGBP income. If you would like to write it down, you can pause the video here. This is your house property. And PGBP is this one. And also one more note regarding IFRS. Okay. So this is although a small note, but it was important. So dividend income is your IFRS income, but dividend, again, it was given the net amount was 18,900. So you have to gross it up. You have to gross it up. So you understand, on dividend, the rate of TDS is 10%. So this amount which you have received is equal to 90%. So once you will gross it up, it comes to 21,000. If you remember the section of dividend, section 194, you can write it. Otherwise, it's perfectly fine if you don't write the section number also. It is perfectly fine. I'm again saying it is perfectly fine. But yes, you should know that on dividend, we deduct 10% TDS. Similarly, on honorarium. Honorarium is a kind of professional services which you have rendered. So again, it was mentioned that this amount was net of TDS. So on honorarium fees, 10% TDS would have been deducted. You understand the TDS rate of 194J professional services. So you have to gross it up. So this was equal to 90%. When you will gross it up, it will be 25,000 rupees. Interest on income tax refund. See, if it would have been just income tax refund is not our income, but the interest on income tax refund will become our income. So this is 1,500 rupees. And a very important point over here. Here the assessee has given some gifts to daughter-in-law. And on that gift, this daughter-in-law has earned some income. So that income will be clubbed in the hands of transferor. So this is the clubbed income, 10,000 rupees. You have to consider this also important. So our total IFRS income comes to 57,500. You can note it down. Got it? Okay. Now our main answer. So here you have to compute your income and tax liability of Dr. Rohan as per optional tax regime. So we have created all these working notes. Note 1, house property, PGBP, IFRS. Gross total income comes to this much. 80C is okay. 55,000 is PPF. 80D, very important point over here, because it was very smartly given by the examiner, because they, in this question, they have nowhere mentioned that this person has paid any insurance premium. But yes, we understand that this person is a senior citizen and he has incurred medical treatment expenses of 70,000 rupees. That is also covered, duly covered under 80D, remember? But yes, in 80D, maximum deduction can be given up to rupees 50,000 only. So that is the reason assessee has paid 70,000, but we will be giving maximum 50,000 deduction. 80G was easy, PMKS 100% reduction is available, 10,000 rupees. So our total income comes to 7 lakh 1,000 rupees. Again, you have to see whether this income contains any special income like LTCG, triple 1A, 112A or casual income. So in this case, there was no special income. So we'll simply apply the slab rates. And here the assessee is following optional tax regime. That is the reason we will apply the slab rates, and the assessee is a super senior citizen. On first 5 lakh, the tax would be nil. Got it? And on the remaining amount, the tax would be 20%, which is not exceeding more than 10 lakhs. So it is 20% plus 40,260 plus 4% cess is 1610. So tax liability comes to 41,870. Now, the question is not yet complete. Now, this is again very important. Some students might leave this question over here only. But please remember that here in this case, some TDS was also deducted. So you have to take the credit of all these TDS. So we have already discussed that on 5,85,000, this is the amount, this is after TDS. So this amount was 90%. So how much is the TDS? 10% was the TDS. So we have simply done this calculation that 10% TDS was deducted. If you remember these sections, you can mention these section number. Otherwise, no, perfectly fine, right? So 65,000 TDS was deducted on fees, on dividend. You just calculate this amount. 2,100 was deducted on dividend, on honorarium. 2,500 was deducted. So the total TDS was deducted was more. In fact, our tax liability was just 41,870. And if you calculate this, this was amount. This was almost around 70,000 something. So when you will subtract, you will get the tax refundable. You will get the tax refundable of 27,730. Got it? Okay, now I would request you to pause the video here and you can write it down. Should I zoom in? Okay. You can pause the video here. Okay. Pause the video here. Okay, and now the second part. Second part says that if the assessee is following optional tax regime but with presumptive taxation under section 44 ADA, then what will happen? What will be the change? My PGBP income will be changed now. So house property income will remain same, IFRS income will remain same, only my PGBP income will be changed here. So 44 ADA says whatever is your gross receipts. We have already calculated the gross receipts in our working note, 18 lakh 5,000. So here we have to assume tax at a rate of 50%. So it will be 9 lakh 2,500. And this house property, because since it's following optional scheme, this can be set off. So after this, we'll get the GTA of 9 lakh 30,000 rupees. Deductions we have already computed. Please don't show it again and again, because here you have already shown that we have given these deductions, and this will be same in that particular option also. So you don't have to write it down. Please remember, guys, please don't write it down. Please don't repeat it again. You have to just simply take this reduction amount. How much was the amount? 55 plus 50 plus 10,000. Please add it up and only that just show that we have already computed this. You have to show in your examination. Please save the time in your examination. Got it? So this is perfectly fine, because the examiner know that because examiner will understand that the student knows this particular provision, as you have already shown in the first part. So you will say already computed. Total income comes to this minus this, 8,15,000 rupees. And on this amount, there was no special income. So you can calculate the tax on first 5 lakhs, so and so, on remaining amount this. So my tax liability comes to 65,520. And TDS, again, I have, please remember, guys, I have again said over here that we have already computed this amount. Why? Because here we have already computed this amount. So you don't have to show it again. Guys, if you will repeat it, you will waste your 3 to 4 minutes over here. Please save the time. So this, you can just simply add this up. So this was the TDS already deducted. So 69,600 was already deducted. 4,080 comes our tax refundable. This option is not good. Why? Because my tax refundable is so low over here. In that case, it was 27,000 something, but here it is 4,080. This is very important because now you have to advise that this option is not beneficial. Why? Because the tax refundable is lower here. In that case, it was more. Got it? This was your question number 2. If you would like to pause the video here, you can pause it right here. Now come to our next question. Okay, next question is question number 4. I would again request you to pause the video here. Here. Pause the video here and give a plain reading to this question. Just a plain reading. Okay, I'm changing the screen. Pause the video here. Okay, there are so many points given. Next page, you are required to compute the total income and tax payable of Mrs. Nisha for assessment year 24-25, ignoring the provision of 115 BAC. So here again, we have to compute the income as per the normal provision of the assessee. Let's read this question and let's discuss these points one by one, and then we will do this question. Okay, easy. Mrs. Nisha is a resident individual, age 54 years, not a senior citizen, is carrying on business of manufacturing of textile fabrics as a proprietor. Please understand that she is having a business of manufacturing, and here the assessee is not following default regime. The assessee is following optional tax regime. So if the person is into manufacturing business and that person is following optional tax regime, we remember that there is a point of additional depreciation. So if this assessee will be purchasing any new plant and machinery, that machine would be installed in the factory. So in that case, we can give additional depreciation also, right? But in default tax regime, we don't give additional depreciation. And this additional depreciation is only an optional scheme for manufacturing assessees. The turnover in the previous year was 250 lakh. Okay, the last year turnover was above 1 crore. So this assessee is also eligible to deduct TDS. So whenever she will be making the payment, she should deduct TDS also if TDS provisions is applicable. Otherwise, 30% of that amount would be disallowed. And the current previous year, the turnover is 600 lakh. Okay. The net profit as per P&L account as on 31st March 2024 is 5,61,000. See, in this question, P&L account is not given, but they have given the net profit as per P&L account. So this is our starting point for computing our PGBP income. Got it? So this will be our starting point. And whatever the adjustments is given over here, whatever the information is mentioned to us, we will work accordingly. So this should be the starting point for computing PGBP. She provides, so she has PGBP income. Let's see if she has some other income also. She provides the following additional information. Those were not considered while making the P&L account for the previous year 23-24. They have given certain information to us, and now they are saying that these points were not considered while preparing the P&L account. Okay, let's see what are these points. So we have to consider, if these points should be considered, then we have to consider it accordingly, right? Okay. First point says depreciation has not been debited to P&L account. They have not debited the depreciation. So we can allow depreciation, right? So this is the starting point and we will be allowing depreciation. They say the details of plant and machinery employed in the business are given as center. Okay. Opening WDV of plant and machinery is this much. On this date, new machine was purchased during the year. Payment made by an account paycheck this much. On this date, she sold one of the machine for this amount. Okay. She does not have any other fixed asset. So it means that we have to compute depreciation on this amount, right? So this is the opening value, this is the additions during the year, and this is the money received on sale. So whatever the amount which will be received, which will be getting after this computation, this plus this minus this, right? So on this amount, we will be computing depreciation. And there is a new machine also, which is introduced during the year. And this was purchased, put to use date is not given. So we'll assume the same date is put to use date. It is 3rd of July 2023. So if you calculate, it will be approximately 9 months. So it is more than 180 days, of course. So here you will be charging the full depreciation. And also because this is a machine and they have specifically mentioned that it's a new machine. And as I was discussing, the RSSE is a manufacturing assessee. Second thing is that they are opting for optional tax regime. So you have to give additional depreciation also. Correct? Okay. So this point would be used for computing our depreciation. Second point says received subsidy of 20% on new machine purchased on 3/7/23, this machine during the previous year under technology upgradation fund scheme from the central government. Okay. This point is also related with this point, because this, in point number B, they say that we have received, the assessee has received a subsidy of 20%. See, we understand the actual cost of an asset which we should take. There is a section 43(1). I think that you don't remember that section. That's okay. But there is a section, if you remember, then it's very good. Section 43(1) is a section related to actual cost of the asset. Even if you don't remember the section number, but you know the provision. In this section, it is mentioned that whatever is the actual cost, whatever is the purchase price, it becomes your actual cost. If there is any installation expenses which you are incurring, or any interest which is related up to the date of put to use, that should be capitalized, right? That section also says that if you receives any amount from any other person, or any form of grant or any form of subsidy from any other person, if you have received any amount, so your actual cost would be reduced by that, right? So here the assessee has received 20% as a subsidy from the government or from any other person. Not necessarily government, here it is actually government, but it could be from any other person. So if you received some amount from any other person, so obviously your cost of acquisition would be reduced. So 7,25,000 is the purchase price, but you have received subsidy of 20%. So what you will do is, when you will be computing your depreciation, so you will be computing your depreciation on, you will be when you will be writing that point additions during the year, would you be writing 725, or you will be subtracting the amount of subsidy? Please subtract the amount of subsidy, right? So 20%, please subtract it. So 7,25,000 minus 20%, so this would be 5,80,000. Please don't take it 725 now, please take it as 5,80,000. So this point is related to depreciation point, right? So additions made during the year is not 725, it would be 5,80,000. And now the additional depreciation will be on actual cost, and now the actual cost would be 580, not 7.25, it would be 5,80,000. So 20% of actual cost would be 580,000, right? Good point. Then it says, C point, it says she paid a job charges for the value addition on fabrics of 90,000 without deduction of TDS. So we understand her turnover was much more than 1 crore rupees. She was eligible to deduct TDS, and she has not deducted TDS. 30% of this would be disallowed. We know that there is a section 40 small a which says that 30, if you are making a payment to a resident, then you have to make a payment with, after deducting TDS, you have not deducted it, you have not deposited, 30% we are going to disallow. Okay, this is the point which is very common now. You understand this point. D point. It says commission paid to one agent allowed as deduction in earlier assessment years. Okay, there was some expense of earlier assessment year. We have allowed it in our P&L account. It was an expense amounting rupees 50,000 has now been received back from during the previous year 23/24 from the agent due to the settlement with the commission agent. So there was an expense in the earlier years. Now we have recovered it back. So it would be deemed PGBP income, section 41. So this will make this 50,000 rupees as your business income. Add this in your PGBP. 25,000 paid to creditor for goods in cash. Please disallow it. Why? It is more than 10,000 rupees. Please go and disallow this 25,000. Add it back. Entire the excess over 10,000 or the entire amount? The entire amount, 25,000 rupees. You have to add it back. F point says incurred loss of 1,17,500 from an eligible transaction carried out in respect of trading in derivatives in a recognized stock exchange. What it is? Sir, it is a business income. So this is actually it's not an income, it's a loss. So this assessee has incurred a loss of 1,17,000. From where? From trading in derivatives in a recognized stock exchange. So when you trade in derivative, is it a speculative business? The answer is no. We understand if it is a for any speculative business, if there is any speculative business loss, that speculative business loss can only be set off from speculative business income, not from any other business income. But when we read that speculative business income definition, that meaning of that speculative business, it specifically says that if the assessee is into trading of derivatives, and that is happening on a recognized stock exchange, it will not be treated as a speculative activity. It will not be treated as a speculative activity. I'm again repeating, trading in derivatives in RSE, in recognized stock exchange, is not treated as a speculative activity. So it will be considered as a normal business activity. So here we have a loss. So this loss can be set off from this business. So now, because this is not speculative, this is a normal business loss, non-speculative business loss, you can please set it off, right? It is a normal business loss, you can set it off. Okay. So here is the point of set off also. G point says, interest received amounting rupees 2 lakh duly authorized by a partnership deed of Messrs. Ramji Textiles 15% per annum on the capital employed. She is a sleeping partner in Ramji Textiles. Okay. So RSSE, Mrs. Nisha, she's running her business, but she is also a partner in some other partnership firm. So she is a partner, although she is a sleeping partner, that is non-working partner. So she has received from that partnership firms, she has received interest on capital, right? It is written over here. Interest received amounting rupees 2 lakh, that is on capital employed. So she has received interest on capital from that partnership firm. Now we understand there is a section 28, a very important section, charging section of PGBP. It says that if you are a partner and if you receive remuneration, interest on capital or other remuneration, then it becomes your PGBP income, right? And although she is a non-working partner, but interest on capital would be the remuneration, right? But maximum it is allowed 12%. 12% is allowed for that partnership firm, because that partnership firm in their P&L account, whatever the expenses they have allowed, it will become the income of the partner. That remuneration becomes the income of the partner. So they have debited 15%, but how much it is allowed for that partnership firm? Maximum 12 as per the partnership deed, but not more than 12%. So here that partnership firm has paid an interest of 15%. So whether that 15% entire amount would be allowed to that partnership firm, the answer is no. Only 12% would be allowed, 3% will not be allowed. So this, whatever is allowed to that partnership firm, whatever the tax that partnership firm will save, this partner will have to pay tax, right? So this partner's income would be under the head PGBP, whatever is allowed to that partnership firm. So please tell me, she has received 2 lakh rupees and 2 lakh rupees is equivalent to 15%. So with his entire 2 lakh rupees would be her PGBP income? No. What you will do is, again, you will do a simple mathematics, that this is equal to 15%. So what amount is equal to 12%? So simple, it is 2 lakh divided by 15 into 12. How much it is? 2 lakh divided by 15 into 12. It would be 1,60,000, right? 1,60,000 will become her PGBP income, right? So this is another PGBP. One PGBP is this business income. This is PGBP number 2. Okay. Then we have H point. It says she received 60,000 by a premature withdrawal from deposit, including interest of 5,000 in post office time deposit, eligible for deduction under section 80C. Very good point. She has made a term deposit in some post office or so. She has made a term deposit and she was claiming 80C earlier. So it says that from that particular term deposit, she has withdrawn that amount. That is premature withdrawal. See, 80C deduction is available whenever you deposit, whenever you do FD for minimum 5 years, right? So 80C is available, but that amount should be deposited up to the maturity. That is minimum 5 years. But if you will withdraw that amount before 5 years, that we can say premature withdrawal, it will become your income. Why we are making it income? Because you have taken a deduction under 80C earlier, right? Because it was eligible for 80C. So you might have taken a deduction earlier. Now you have done a premature withdrawal out of it. So we'll make it an income. So this will become your IFRS income. How much? 60,000 rupees will become your IFRS income, including interest, which is included here. So 60,000 rupees, please make it IFRS income. Why? Because you have claimed 80C earlier, but you have not fulfilled the condition. You have withdrawn it. That is premature withdrawal you have done. So we are going to tax you as IFRS. Okay. I point says she sold her gold bracelet jewelry, capital gain income. So she has IFRS income also, she has PGBP income also, and capital gain also. She sold her gold bracelet used for her personal purposes on 1/5/23 for rupees 5 lakh. 5 lakh would be the full value of consideration. which was acquired for rupees 40,000 on 1/3/2005, more than 3 years, long term. So what you will do is you will be calculating your long-term capital gain. 5 lakh would be the full value of consideration. 40,000 would be the cost of acquisition. Please index it. You will be provided with the CIF for this year. A diamond was embedded onto bracelet on 1/5/2007. What it is? Cost of improvement. So this is 40,000 cost of acquisition. Please index it. This is cost of improvement. CI is given to you. This is a easy point. You can calculate your long-term capital gain. So here would be a long-term capital gain. And if there is a long-term capital gain, it is a special income. You have to pay tax at a rate of 20%, right? Okay. J point says she received a gold coin bullion worth rupees 55,000 from her cousin during the previous year 23-24. So what it is, this is a gift which you have received from the cousin. So cousin is a related person? No, it is not under the definition of relative, and this amount is a capital asset. Gold is a capital asset, and the fair market value is also more than 50,000 rupees. So if it is more than 50,000 rupees, this entire amount will be taxable as IFOS. So please make it IFOS income. She incurred a long-term loss from sale of shares of Indian company. The STT is paid is 75,000. Okay. So this is actually 112A, but there is a loss. You don't have to compute 10% income because this is a loss. So we have a long-term capital gain also in this point, and we have a long-term capital loss also. So you understand long-term capital loss can be set off from long-term capital gain. So if there is a long-term capital gain of more than 75,000, please set it off from here. If it is not, could not be set off due to, if let's say I have not calculated it, but if you will calculate it, I think it will be more than 75,000. But in case if the amount is not sufficient, then that loss cannot be set off. You understand, long-term loss can be set off only from long-term gain. If it could not be set off, then it will be carried forward for next 8 years, right? So we'll see if it could be set off. Then it says, next point says, she deposited a sum of 50,000 with Life Insurance Corporation India every year for the maintenance of her mother, age 70 years, dependent upon him. Life insurance. So whenever this life insurance term comes into picture, our mind goes to 80C. So whether 80C would be available, the answer is no, because she has deposited for her mother. So 80C would not be available because 80C is not available for parents. But we understand here the person is suffering from, she is suffering from severe disability. So we have section 80 DDP, sorry, 80 double D, 80 double D, disabled dependent. So we have section 80 DD, disabled dependent. So this section says if the person is suffering from disability, then a flat deduction of 75,000, irrespective of the amount incurred, the flat deduction of 75,000 would be available. And if the person is suffering from severe disability, then 1,25,000 deduction is available flat. So here the person is suffering from severe disability. So please take 1,25,000 under section 80 double D, disabled dependent. Okay. DDB was related to your prescribed disease. Okay. M is she purchased the new industrial house. Sorry, she purchased a new residential house during the previous year and paid stamp duty and registration fees of 155 to get the transfer the property in her name. Okay. So here this 1,55,000 is the stamp duty charges of the registration fees charges. So we understand this is eligible under section 80C. So if the person has purchased a residential house and if they have incurred for, if they have either they have made the payment regarding principal repayment or for stamp duty or for registration charges, that is allowed under section 80C, but maximum deduction is 1,55,000. 155 will not be allowed, only 150 would be allowed. So in 80C we understand maximum deduction is 150, right? Okay. Now there is one more point over here. It could be, but the thing is that they have not mentioned that how much this was a residential house. Otherwise, we could have, because there is a long-term capital gain and the assessee has purchased a residential house also. So there could be the possibility that we could take section 54F deduction also, right? Because exemption in section 54F, because this person has sold gold jewelry, there is a long-term capital gain. 54F condition is almost getting satisfied. But here the point is that we will not be able to claim 54F exemption. Why? Because the value of the residential house is not mentioned. Otherwise, if it would have been mentioned, then we can take that 54F also, but 54F would not be available over here because the value of the house, the cost of the house is not mentioned over here. Only we can take 80C deduction, but that up to only up to rupees up to 150, right? Because 80C is only up to 1,50,000 rupees. So again, an interesting question. I would again request you to pause the video here Do as much as you can, and then please compare the answer with my answer. Okay. So this is the answer for question number 4. Your PGBP income is 442,500, capital gain is 166,930, IFO is 1,15,000, GTI 724,430, and after this deduction, your total income comes to 449,430. Let us discuss these working notes first. So first of all, PGBP working note. Net profit is given as per P&L account is 561, and you have to make certain adjustment. First of all, it is mentioned that you have to compute the depreciation also, and here all these things were given. So that is the reason I have written all these things, right? Opening WDV was this much. Additions during the year was 7,25,000. But you remember that 20% is the subsidy which we have received. So we have to subtract that. So our actual cost would be 580. Guys, this is important, right? Money received on sale is 75,000. So the WDV at the end is 9,80,000 rupees. And there was no particular asset which has been used for less than 180 days. So in this 9,80,000, you will apply the full depreciation 15%. The normal depreciation is 1,47,000. Also, the assessee has purchased plant machinery, that is again a new machinery, and this assessee is a manufacturing business. And most important, this assessee is following optional tax regime. So in optional tax regime, if all these conditions are satisfied, we can give the additional depreciation. And if the assessee would have been following default tax regime, guys, then there would be no additional depreciation in that case, right? But here we can give the additional depreciation also. How much amount? The actual cost of the new asset is 580, not 725, 580. 580 into 20%. So because it is also used for more than 180 days, so it would be 5,80,000 into 20%. Total depreciation comes to 263. Got it? And this was easy. Job charges paid without TDS, 30% would be disallowed. Commission, which we have recovered, we have already claimed the expense in earlier years. Now we are recovering it. It will become our team business income, 50,000 rupees. If you remember this section, you can write it. Otherwise, it's okay. And this is the amount which you have paid in cash. So it will not be allowed. So our income from this business is 4 lakh. Our income from this business is 4 lakh rupees. But yes, there are certain other PGBP income also. What are those? First of all, we are the assessee is a partner, although that person even is a sleeping partner, but yes, interest on capital can be allowed to all the partners. So interest on capital which this person has received from other partnership firm, this will become his PGBP income under section 28. Correct? Under section 28, it will become our PGBP income. But please remember, only that will be our income, whatever is the deduction which has been allowed to that partnership firm. We understand that partnership firm in their P&L account, they can only charge up to 12% of interest, right? Interest on capital. So whatever they can charge, it will become our income. So here this 2 lakh rupees was equivalent to 15%, but we can only make till the income till only 12% here. So the income would not be 2 lakh, the income would be limited to 12%. It would be 160. I believe that this is clear to you. And yes, so our total in the PGBP income comes to 4 lakh plus 160, 5 lakh 60,000 rupees. And this I have already discussed. This is the income from derivative trading, and it is happening in a recognized stock exchange. It is not regarded as speculative. It is not speculative. It is a non-speculative. It's a normal business loss. So normal business loss can be set off from this PGBP. So finally, our PGBP comes to 442, 500. Got it? So you can, if you would like to write it down, you can pause the video here. This is working note number 1, PGBP. Okay. You can pause the video here. Now we have other working notes also regarding capital gains and IFRS. So see, first of all, the assessee has sold jewelry also, and this jewelry is again a long-term jewelry. Cost of acquisition was 40,000 rupees. You have to index that. Cost of improvement was also there because assessee has subsequently made some expenses related to improvement, 50,000 rupees. So this would be our full value of consideration. This is the cost. So our long-term capital gains comes to 241,930. This is long-term capital gain, 2,41,930. And yes, it is also mentioned in the question that the assessee has long-term capital loss on equity shares. You understand long-term capital loss can be set off from long-term capital gain. So after set off, we have long-term capital gain of 166,930. Please remember, here you have to pay tax at a rate of 20%. Correct? And also there is an IFRS income gift which we have received more than 50,000 rupees. And again, 80C deduction we were claiming on any deposit, but that deposit has been withdrawn prematurely. In this case, on premature withdrawal also, this will become our income. The total income IFRS would be 1,15,000 rupees. So this is our working note number 3, IFRS. If you want, you can pause the video over here. Correct. Now comes to your main answer. See, this we have discussed. So our GTI would be 7,24,430. Then chapter 6A deduction, ATC. Why ATC? Because the assessee has paid 1,55,000 for stamp duty charges for registration fees. So we understand that this is allowed under ATC, but maximum deduction is 150. 80 double D. 80 double D. You understand that the assessee is maintaining a disabled dependent, and here the whatever the amount which the assessee has incurred, irrespective of that amount, there is a flat deduction of 75,000. But if that disabled is severely disabled, then the flat deduction comes to 1,25,000. So we have given 125. So after these deduction, Total income comes to 449,430. Correct? Here the income is less than 5 lakh rupees, so it is not more than 5 lakh rupees, so rebate will also be available. Correct? But first of all, calculate the tax on this. So will you calculate the tax on this amount on the normal slab rate? So, or is there any special income also? We have special income. Which income? We have LTCG. So how much is the LTCG? 166,930. So on this amount you have to pay 20% tax. But please, guys, this is an important point. Please remember that whatever is your special income, don't just simply calculate tax blindly. First of all, calculate your other remaining income also. Please check. Once you have to check whether this other remaining income is more than basic exemption limit or not. If it is less than basic exemption limit, so you have to also move certain amount from this long-term capital gain to here also. Remember that if the assessee is a resident individual or HUF, in that case, movement is also allowed. Correct. But here our remaining income was more than basic exemption limit. So here the question is simple. You can simply say that 20% tax would be on 166,930, this much amount, and remaining income there would be the slab rate which would be available. So the total tax comes to 35,011. But yes, rebate of 87A would also be allowed because the assessee is a resident individual. Maximum rebate under section 87A is 12,500. So after rebate, the tax would be this at 4% cess. Tax liability would be 23,411. And you can write, if you remember the section, you can write it. Otherwise, forget the section number. But yes, you have to round off your tax liability. Correct? So 23,410 is our last amount. If you want, you can pause the video over here. And also here. Right. Now come to our next question. Okay, the next question is question number 5. Okay, so you have to read this out first. See, guys, I'll not be helping you much in this question. Right? You have to apply your logics, your provisions. Although I'll be solving it, then you can compare your answer, but I'll not be explaining each and every point over here. And I know that you will be able to do it. Pause the video here. Read it. Okay, I'm changing it. Pause the video here. So there is an opening and closing balance adjustment is over there. You can do it. I'll discuss the second point. Okay. Third point. Okay, I'll discuss. I'll not discuss fourth point. I think you will be able to do it yourself. Fifth point. Okay, I'll discuss. Read it? Okay, I'm changing it. Pause the video here also. Okay. So here in this question, I'll not read the entire question. First of all, this person is of senior citizen, 61 years of age, engage in business of manufacturing. Again, a manufacturing person. Something is given. I'm not reading it. Profit on sale of scientific research asset 2 lakh. They have written it over here. Winning from lottery 31,500 net of TDS. Please gross it up. First of all, while computing your PGBP, take it out. Take 31,500 out from here while computing your PGBP, and then take it to your IFOS, but at a gross value, right? This is net of 30% TDS, so this is equivalent to 70%. How much is the gross value? 31,500 divided by 70 into 100, you know. Opening and closing stock, you will do. Opening and closing stock is undervalued by 10%, and they have given the opening stock value and the closing stock value also. So how much it is undervalued? This amount is 90%. So what would be the correct value? 4,50,000 divided by 90 into 100. This 5 lakh would have been the correct value. So 50,000 by 50,000 rupees, this opening stock is undervalued. Similarly, the closing stock is undervalued. You will do it. Okay. Then you can check with my answer, right? But you will do it. Second point says, I'll explain this point. Salaries and wages includes the following. Salaries and wages. There was some salaries and wages. Salaries and wages includes the following items. What it is? Contributed 20% basic salary in National Pension Scheme referred under Section 80 CCD regarding salary paid to an employee, Mr. Ganesh, who has withdrawn basic salary this much, DA 40%, 50% forming part. Okay. You understand that if the employer contributes towards national pension scheme, then it is allowed up to 10% of salary. If it is in excess of 10%, then we will not allow it. So here the employer has contributed 20% of basic salary. So the employer has contributed, say it is written over here that the employer has contributed 20% of the basic salary. So 20% of basic salary is 3 lakh. So the employer has contributed 60,000 rupees here. So is it allowed? So we can only allow 10% of salary. Salary here means basic salary plus DA forming part. So the basic salary is 3 lakh. DA is 40%. 40% means 1,20,000. And 50% forming part. So DA which forms part is 60,000. 3 lakh is basic salary. DA which forms part is 60,000. That is 3.6 lakh. So 10% of 3.6 lakh, only 36,000 is allowed. So the remaining 24,000, which the assessee is claiming extra, we are going to disallow that. So you'll be able to do this also. Interest on loan include 15% per annum on loan of 12 lakh, which was taken from State Bank of India on 1/5/2023. 1/5/2023 means 11 months. And this was purchased for electric car of 15 lakh. But the loan was for electric car was 15 lakh, but the loan was for 12 lakh. Okay. So how much is the interest? 12 lakh into 15% for 11 months. And this car is used for personal purpose. So please disallow that interest for 11 months. So 12 lakh into 15% for 11 months, please disallow that because this is for personal purpose. And then because this is an electric car and the assessee is following optional tax regime, so you can give a deduction of 80 EEB, but maximum it is 1,50,000. Okay, then you will solve it. Depreciation is allowed, you can do this. They have this much is the depreciation, and there is also a vehicle of rupees 3 lakh. They have not charged depreciation. Please charge depreciation on this also, right? And will you be charging additional depreciation on this amount because this person is a manufacturing assessee? Answer is no, because this is a motor car. Additional depreciation is not allowed on vehicles. It is not allowed on aircraft. It is not allowed on ships, right? So only normal depreciation you will be claiming it. And this is 25th of August. That is 180 days or more. Full depreciation, 15%. 30% or 15%? 15%. This person is not into hiring of goods vehicle, right? So this person is just a manufacturing person. If this person has purchased any vehicle, so for that only 15% rate is applicable, not 30. 30% is only for those individuals who are into such kind of business of hiring of vehicles, right? Fifth point says an asset was purchased for 6 lakh on 17/11/2022. Okay, some 2 years back, they have purchased an asset for 6 lakh for scientific research purpose and claimed deduction under section 35 also. So see, they have purchased an asset for 6 lakh rupees and they have claimed a deduction also of section 35 in that year. So obviously in section 35, under section 35 in that year, they must have claimed 6 lakh deduction. So how much is the written down value now? 0. Why? Because the original cost of the asset was, see, I have explained this in the revision also. The original cost of this asset is 6 lakh and they have already claimed deduction under section 35 earlier. So now 100% deduction is available. So how much is the written down value? 6, 0. It is 0 net, right? And now they are selling it for rupees 8 lakh. Now they are selling it for rupees 8 lakh. So first of all, from 0 to 6 lakh, this would be your, because now it is getting sold for more than the original cost. So there would be PGBP income also, there would be capital gain also. First of all, the PGBP income would be up to this 6 lakh. Up to this 6 lakh would be the deemed PGBP under section 41. 6 lakh would be the deemed PGBP, and over and above the 6 lakh would be the capital gain. So it depends. 8 lakh is the full value of consideration. Cost of acquisition would be 6 lakh. If it is long term, then you have to do the indexation for the 6 lakh also, right? 8 lakh minus 6 lakh indexation also, but it is not long term because you have just purchased it on 17/11/22 and you are selling it in on 5th of September 23. It is not more than 3 years, so it would be a short term. So simply you will say 8 minus 6, 2 lakh would be the capital gain. So 2 lakh would be the short term capital gain and 6 lakh would be the PGBP income, right? But they have shown 2 lakh rupees only PGBP income in their PNL account, which is not correct. So what you will do is while computing your PGBP, simply disallow this amount. Simply add it because they have already taken it as an income. So please don't consider it. So what you have to do is you have to subtract this, right? Because you will be making a separate calculation for this amount. So please subtract this 2 lakh rupees, and then after you will be, because this is they have shown in your credit side of your income account, right? In your P&L account. So please subtract this amount of 2 lakh rupees and add 6 lakh rupees as PGBP income. And that 2 lakh rupees, which is over and above the original cost, will go in your capital gain. Okay, this was a good adjustment over here. And here the assessee has, there's an industrial land for the assessee, which was compulsory acquired by the government, and the government is paying 12 lakh rupees compensation. So this asset is compulsory getting acquired. So when they are receiving compensation in this year itself. So this would be the capital gain again. 12 lakh would be the full value of consideration. Cost was 2 lakh. It was purchased way back. So it would be a long-term capital gain. So please calculate a long-term capital gain also, because you understand in the case of compulsory acquisition also capital gain will arise, but capital gain is taxable in the year when this compensation is received. So this compensation is getting received in this year itself, in the month of February 2024, which is in this previous year itself. So please compute the capital gain also. 12 lakh rupees is the full value of consideration, and please do the indexation for this 2 lakh rupees. And it is mentioned that this person has purchased another plot for industrial land of rupees 6 lakh rupees. So there is a exemption of section 54D which is available. So how much is the 54D which would be available? The amount invested or capital gain, whichever is lower. So please apply 54D also. And the assessee has also received interest of 54,000 as on compensation. You understand, interest on compensation is not capital gain, it is IFRS income. And second important thing is that whenever you receive interest on delayed compensation or delayed enhanced compensation, 50% flat deduction is available. So please make it IFRS income after 50% straight deduction. So out of 54,000, 27,000 would be your IFRS income. Now you have to calculate your income and your tax liability. So I would again request you, please do this question as much as you can. I know that you will be able to do this question and then compare with my answer. Let's start with this. So this is your answer number 5. Once you will check our PGBP, although we have made a note also of PGBP, but our PGBP is 24,58,000. We have a capital gain of 205128, out of which 5128 is long-term capital gain, and we have IFRS income also. So we have GTI of 27,35,128, and there is a deduction of 80 EEB. So our total income would be 25,85,128. Okay, first of all, come to these working notes. First of all, we'll calculate the PGBP, and the working note for this is net profit as per P&L account is given to us. Depreciation as per books. Why we have added it back? Because in the question we have been provided with the depreciation as per section 32. So that is the reason as per the books we have added it back. Profit on sale of scientific research, we will do a separate calculation. That is the reason it was credited. So I have deducted this amount less. Winning from lottery, it was credited again, but it is your IFRS income. So whatever the amount which was credited, I have deducted it 31,500, and this will go in our IFRS. But please remember, in IFRS, whenever we will take it, we will take it at a gross value, not a net of TDS. It should be before TDS, correct? There were adjustment regarding opening stock and closing stock. So opening stock was undervalued, so we have to make it correct. So how much was the opening stock we have recorded? 450, but it was undervalued by 10%. So it means that it is equivalent to 90%. So by how much amount it was undervalued by 10%? So that comes to 50,000 rupees. Why I have deducted this? See, now you are making your opening stock correct, right? You are increasing your opening stock value. So when your opening stock value would be increased, it means your expenses are getting increased. So if your expenses are getting increased, so what impact it will make on profit? My expenses are getting increases, my profit will be decreased. So that is the reason it is subtracted, correct? And similar explanation for closing stock also, because closing stock was undervalued at 5,58,000, which is 90%. So by how much amount it is undervalued? By 10%. So 62,000 is the 62,000 is the difference. So now you will be increasing your closing stock. So if your closing stock will be increased, see, it comes in your P&L account credit side. So if your closing stock will increase, it means your income side is getting increased. So your profit will be increased in that case. That is the reason it will be added, correct? And this excess contribution to pension scheme I have already discussed, that the actual contribution by the assessee is 3,20,000, that is 60,000 rupees, but which is allowed as per section 36 is 10% on salary. And here we take salary as basic salary plus DA forming part. So our DA was 1,20,000, but out of which 50% was forming part. So that is total 3.6 lakh, 10% we can allow. So 36,000 can be allowed, but we have already deducted 60,000 rupees. So how much is the extra expense we have shown in our P&L account? 24,000. So we will add it back, right? VRS expenses we have already discussed that 1/5 only will be allowed, 4/5 will be disallowed. This is related to your personal car expenses, interest of 11 months. You will add it back. Here you will take depreciation as per section 32, which is mentioned in your information. Plus there was a car of 3 lakh rupees. This is not this car. This is not personal car. This is another car which is used for business purpose. And you will claim 15% depreciation more than 180 days. So the total depreciation comes to 495, which you can allow. And this is again important scientific research asset, as I've already discussed, because here, see, the original cost of this asset was 6 lakh. And how much is the written down value? Because you have claimed deduction under section 35. So the written down value was nil. And now you are selling it at more than this amount. In fact, it is going above your original cost. So you understand, the amount up till original cost will become your PGBP income. So 6 lakh would become your PGBP income under section 41. And over then above your original cost will become your capital gain. So this is how your PGBP income is computed, 24,58,000. If you want, you can pause the video here and you can see your PGBP note. Correct. And your capital gain note also. See, you have sold your scientific research asset over and above your original cost. So how much it was? 8 lakh full value of consideration. Your original cost was 6 lakhs. So 2 lakh would be your income. Will you be indexing this particular cost of acquisition? The answer would be, if this scientific research asset was held for more than 3 years, then you can index it. But here it was sold before 3 years. So that is the reason it would be a short-term capital gain of 2 lakh rupees. And again, the assessee's industrial land is compulsory acquired by government, and the compensation also we have received during this year only. So that is the reason this capital gain will arise in this previous year. Full value of consideration, the compensation amount which we have received is 12 lakh rupees, and 2 lakh was the original purchase price, and we will index this cost. It will be 594,872. This is our long-term capital gain. And here assessee has purchased another land also, and so he can avail 54D exemption over here. So after this exemption, 6 lakh would be the exemption, 5128 would be our long-term capital gain. So our long-term capital gain is 5128, our short-term capital gain is 2 lakh. So the total capital gain is 205128, which includes 5128 long-term. Why I have written it separately? Because you understand that on this amount you will be charging 20% tax rate. So this is your working note for capital gain. Got it? Okay. Now your main answer. See, your PGBP income from working note 1, capital gain income from working note 2. Out of this 5128, I have already mentioned that this is LTCG. And IFRS income, winning from lottery. Please make it on the gross level, that is 45,000 rupees. And interest on compensation is 54,000, which you have received. But you understand that interest on delayed compensation, we have a flat deduction of 50%. So only 27,000 rupees would become our income. So 45 plus 27, that is 72,000 rupees. Gross total income is this. And 80 EEB deduction. Why? This is on electric vehicle, but the maximum deduction available is 1,50,000 rupees. So although the interest is 165, but we can avail only 150 deduction over there. So our total income comes to 25,85,128, and you can round it off also, right? So now you will calculate the tax, and remember you have some special income also, like long-term capital gain and winning from like casual income. So you will be applying special tax rates. So on long-term capital gain, you will be applying 20%. So our long-term capital gain was actually 5128, but actually we have now rounded it off. So what I have done is I have added that 2 rupees extra, 5128. I have made it 5130 on long-term capital gain. Correct. Otherwise, if you would have taken 5128 also, this would have been fine. Hardly it will be a difference of 1 or 2 rupees. Correct. But yes, here I have taken 5130 into 20%, 1026. On casual income, we have 30% rate, 13,500. And on the remaining income, we will apply the slab rates. And we understand that the assessee is a resident senior citizen in this case. He's a resident senior citizen. So the slab rate would be 3 lakh rupees. So first 3 lakh nil, next 2 lakh rupees 5%, next 5 lakh 20%. This is easy, you can calculate. So our total tax comes to rupees. If I add my total tax, it comes to rupees 585,026 at cess. This is your tax liability. And yes, on lottery, 30% TDS was already deducted. So the tax payable comes to 594,927. And you can round it off to nearest 10. Right? If you remember this section, you can mention the section number also. Otherwise, it is fine. So this is finally your answer number 5. And I believe that now you must be feeling very, very confident in solving these questions, although we'll be doing some more practice sessions. If you would like to pause the video right here, pause it over here. Okay. And pause the video here. So I'm sure that after doing these questions, you must be feeling very much confident, very much happy. How you have liked this practice session, please give your comments to this video, right? And I would like to discuss some more questions with you. I would like to have some more practice sessions with you. This is the first one. I would like to have some 2 or 3 more sessions with you, although it is a very time consuming process, but I am telling you that this would be very beneficial and you will get results out of it. You will get 100% results out of it, right? So I'll meet you in the next video. Till then, thank you so much. Bye and take care.